Good evening everyone. So in continuation with our last class that is related to input tax credit, we completed up to 17 subsection 4, that is option available to banking company including financial institution NBFC. Now we are looking into blocked credits. Blocked credits, there are broadly three types of blocked credits: motor vehicle blocked credit, then construction related block credit and other block credit. Motor vehicle related block credit, first motor vehicles are divided into three. Motor vehicles used for transportation of goods, motor vehicles which are vessels and aircrafts, and other motor vehicles. Other motor vehicles we have trucks, lorries, etc. So that ITC always available, we don't have any restriction. But motor vehicle for transportation of persons, we need to check the capacity. Capacity does not exceed 13 is only blocked credit, but in that place we have three exceptions. Even though capacity does not exceed 13 is blocked credit, first exception is if it is used for further supply, and number two, it is used in the business of transportation of passenger. Further supply means sale of motor vehicles or giving motor vehicles on renting, whereas used in the business of transportation of passengers or driving skills. These are the three exceptions where IT is available. If the capacity of the motor vehicle exceeds 13, always IT is available without any restriction. Example, buses which are purchased by the company for transportation of its employees, they can take ITC with respect to this. Then vessels and aircrafts, we have four exceptions. Further supply used in the business of transportation of passengers, driving schools, and used for transportation of goods. ITC available. Other cases ITC is not available because that is also blocked credit. And the only difference between these two is that here there are only three exceptions, here there are four exceptions. Here last point, used for transportation of goods, not necessary that they should be into the business of transportation of goods. Even if a jewelry merchant is purchasing a truck for the purpose of transportation of jewelry, even though they are not into the business of transportation of goods, but they are into some other business, but definitely they can take ITC with respect to the vehicle. I mean like this vessel or aircraft which is purchased. So that is the meaning of this, used for transportation of goods. So vessel or aircraft which is purchased by a courier company, or vessel or aircraft which is purchased by a car manufacturer, like that any person can take ITC till the time they are using it in the business of transportation of goods or used for transportation of goods. Used for transportation, they need not be into that particular business, but when it comes to transportation of passengers, they should be into the business of transportation of passengers. And next we have repair and maintenance services, insurance, servicing, hiring and leasing of motor vehicles. These are the four inward supplies related to motor vehicles, vessels and aircrafts. So repair and maintenance service, next insurance, next servicing. Servicing is authorized service center. Hiring, renting and leasing of motor vehicles. What we need to check, if the motor vehicle purchased is eligible for ITC, then on this service also ITC available. If the motor vehicle purchased is not eligible for ITC, on these services ITC is not available. That is with respect to this. And here, while determining the capacity, driver seat should be included. So that is 13 including the driver. And further supply includes purchase and sale of motor vehicles or motor vehicles used in the business of renting, hiring or leasing. So I am into the business of renting of motor vehicles. I buy the motor vehicle, I can take ITC. Even if I take the motor vehicle on rent also I can take ITC, because hiring, renting and leasing of motor vehicle is eligible for ITC if the motor vehicle purchased is eligible for ITC. Same is the case that I am taking insurance service in relation to motor vehicle. If that motor vehicle purchased is eligible for ITC, on insurance service also I can take ITC. So that is this. Repair, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. You are buying a car and that car got insured by an insurance company. That car met with an accident because of which the garage is doing the repair services. The repair bill will be in the name of the insurance company. The insurance company can definitely take ITC. We don't have to check whether the car is purchased by the insurance company or not purchased by the insurance company. Hiring or renting or leasing of motor vehicles as a statutory obligation by employer to employee. If under a statutory obligation, they have to mandatorily provide cab facility to their employees. In order to oblige that mandatory obligation, if they take rent-a-cab service, definitely they can take ITC. Example, companies which are working in night shifts. Then statutory obligation need not be under GST, it can be under any law. Ambulance and caravan. Ambulance and caravan will not be coming under motor vehicles. So for transportation of persons, it will be other motor vehicles because the purpose is completely different. It is for short-term accommodation and for providing, the first aid during the travel. So it will come under other motor vehicles. So IT is always available. Whether IT is available on demo vehicles used by dealer for showcasing and test driving to potential customers. ITC is available on demo vehicles, even though demo vehicles are not further supplied, but it will assist in further supply, because without the demo vehicles which is given for test drive, the sales will not happen. So due to that reason, ITC available on demo vehicles if they are used for promoting further supply of vehicles. But as these demo vehicles are not stock in trade of the dealer, it will be the asset. So they need to capitalize this excluding the GST component. If they capitalize it including the GST component, they cannot take ITC. And next, that is the second point, also sale of such capitalized demo vehicles. So after launch of new model, they will be selling this particular old model demo vehicle. When they are selling it, whether they need to pay GST, yes, because 18.6 will be applicable. So much of the ITC availed on that motor vehicle minus 5% for every quarter or part thereof, because it will be capital goods. So due to that reason, 18.6 will come. ITC avail minus 5% for every quarter or part thereof from the date of purchase till the date of sale, or GST on the sale of such demo vehicle, whichever is higher will be taken. What if we are not taking the ITC on this demo vehicle? Maybe it is capitalized at full value including the GST component. Then in that case, what is the treatment? In that case, this particular point is not applicable. 18.6 is not applicable, but they can go for margin scheme. Which margin scheme? Notification 8 of 2018, which says that sale price minus WDV. So sale price, first time they have purchased newly and they used it and they are selling it. So therefore sale price minus WDV, like that one concept is there. So that margin scheme they will be able to take. If the demo vehicles are used for non-business purpose, just for display, but they are not giving it for test drive. So inside the malls or inside the airport, railway station, they will be keeping the vehicles for display. That is for non-business purpose, means personal purpose, or as a part of marketing service for the manufacturer. Then ITC is blocked, ITC is not available. If it is used for personal purpose, anyhow it is blocked ITC. And even if it is used only for marketing purpose, not for the purpose of giving it to the test drive, then it will not be eligible for ITC. That is given in this circular. Then next one, whether IT is available to the insurance company on the repair expenses. So definitely insurance companies can take ITC on the repair expenses provided the invoice is in the name of the insurance company. But in case of cashless treatment, definitely the invoice will be in the name of the insurance company and insurance company only directly make the payment to the garage. But in case of reimbursement mode, first the insured will make the payment and thereafter the insurance company will reimburse the insured. Then in that case, even though the payment is not made by the insurance company, 180 days section, like rule 37, we have 180 days condition. That 180 days condition is not applicable. Definitely the insurance company can still take ITC even though the invoice is raised by the insurance, like invoice is raised by the garage to the insurance company, but the payment is made by the insured. Suppose if the insurance company is reimbursing only 80%, then to the extent of 80% only they can take ITC. So if the reimbursement mode of claim settlement, insurance company can avail ITC even though expenses are initially incurred by the insured, but only one condition is that the invoice should be in the name of the insurance company. Suppose if the repair cost is beyond the approved claims, and in that case ITC to the extent of amount reimbursed by the insurance company but not the entire repair cost. And suppose if the invoice is in the name of the insured, ITC is not available to the insurance company. What about insured? Insured can take ITC on this, depends upon the motor vehicle purchased eligible for ITC or not, because this insurance, whatever repair services to the insured is eligible for ITC. If the motor vehicle purchased is eligible for ITC. If the motor vehicle purchased is not eligible for ITC repair services, the insured cannot take ITC. That is in the hands of the insured. But insurance company, if the invoice is not in their name, how they can take ITC? They cannot avail ITC with respect to that. Then second, construction related block credit. We have three inward supply: any service, works contract service and goods. So any service includes construction service, interior decoration, architect services, or any other service in relation to construction of immobile property. Works contract service, there will be a single contract wherein they will only do everything and they will provide the material required for construction and they will only do the construction. That particular works contract service. Then any goods purchased for construction of immobile property will be blocked credit. ITC not available. And works contract involves transfer of property in goods as well as provision of service for a single consideration. And there are three exceptions. Exception number one, the restriction is not applicable to the owner of the property. So the restriction is applicable to the owner of the property, not applicable to the supplier. Suppose if there is a builder who is purchasing the material required for construction, he can take ITC. Whereas the owner of the property purchases material, he cannot take ITC. So the above discussion is not applicable to the supplier. That is, if a works contractor receives construction service for construction of immobile property, then ITC is available on construction service. Also second point, construction of plant and machinery. Even though plant and machinery is immobile in nature like lifts, escalators, etc., they can take ITC with respect to the construction expenditure. But plant and machinery excludes telecommunication and pipeline laid outside factory, telecommunication towers and pipeline laid outside factory. If the pipeline is laid inside the factory, then it will be eligible plant and machinery, and for that any construction expenditure incurred, ITC available. The third exception is that if the construction expenditure is charged to P&L, so then also they can take ITC, because that is for repairs and renovation of the building. So if construction expenditure is charged to P&L, then also ITC can be availed on above inward supply. These are the three exceptions. And even though ITC is available to the builder, it is subject to the condition that the outward supply of the builder should not be 1.5% or 7.5% without ITC. So what is the first exception that we saw is that the supplier can take ITC. The restriction is only to the owner of the property. So the builder can take ITC, but that is subject to the condition that he is not constructing residential real estate project, because if he is constructing residential real estate project, the rate of GST will be 1.5% or 7.5% without ITC, so they cannot take ITC. But if they are constructing any commercial projects or roads or building land, road, bridges or commercial buildings, etc., then the rate of GST will be 12% or 18%. In that case, ITC is available on inward supplies other than blocked credit. Then whether ITC is available on ducts and manholes used in the network of optical fiber cables. Usually ducts and manholes are laid down by the telecom companies, insurance internet companies, etc., for the purpose of transmission of the data, and that will be beneath the ground. So they will construct the ducts and manholes for the purpose of laying down the optical fiber network, and this ducts and manholes requires construction expenditure. Can they take ITC? Definitely yes. Only telecom towers there is a restriction, but not for these pipelines. Moreover, it is not pipelines which is laid outside the factory gate. That pipelines laid outside the factory gate point is applicable only to the manufacturer, not to the telecom company. So ducts and manholes which are integral part of the optical fiber cable qualify as plant and machinery and can avail ITC on the same, even though used by the telecom companies, as only telecommunication towers are excluded from the meaning of plant and machinery, even they do not fall under the pipeline laid outside the factory. Then only hiring, renting and leasing of motor vehicles is in the block credit, but leasing of any other goods is not covered under the block credit. For example, we have renting of building. Definitely we can take ITC with respect to renting of building. There is no restriction. Renting or leasing of furniture, renting or leasing of building or computers or electronics or any other item, definitely we can take ITC with respect to that. Only for motor vehicles there is a restriction. Works contract service confined only to immobile property, and ITC available on construction of pipelines inside the factory. ITC available on trains. So any rail which is purchased, so they can take ITC, because rail will not come under motor vehicle. Even 2 or 3 wheels with a capacity up to 25 cc, up to 25 cc also will not be coming under the definition of motor vehicles. So therefore they can take ITC. Already this has been tested in one attempt. That is, a company is purchasing 2-wheelers which is having a capacity, which is having the cubic capacity of 20 cc. So whether ITC is available? Definitely ITC available, because that will not be coming into the definition of motor vehicle. So they can take ITC with respect to that. Even rails also they can take ITC. Then this buggies, right, battery operated vehicles they will purchase for use within the premises, like golf court, or even in malls, shopping malls, etc. They purchase some vehicles which are used inside that particular place only. So on that also ITC will be available. Next, other blocked credits you can see here. So we have inward supplies, which is membership of a club, health and fitness center. That's a blocked credit. Even though it is business expenditure, ITC is not available. But the exception, only one exception, if it is incurred by employer to employee under a statutory obligation, then ITC is available. For example, if the membership of a club is under a statutory obligation which is taken by employer for the sake of the employee, then ITC is available on the membership of the club. Otherwise, normally membership of a club, health and fitness center is block credit. Travel benefit extended to employees on vacation. Employee is going on a vacation. The travel expenditure is borne by the company, and the company cannot take ITC with respect to the travel expenditure. What if he is not an employee? Definitely ITC is available. The restriction is only for travel benefit extended to employee on vacation. Suppose if the employee is going on a business visit, definitely they can take ITC, because the restriction is only in case of vacation. And we have an exception, same exception, that is provided by employer to employee under a statutory obligation. Then next, non-resident taxable person, a person who is coming from outside India to India and is not having any physical place of business in India. Just remember, cricketer who is participating in the IPL matches in India will be a non-resident taxable person. They are compulsorily required to get registered, and they will get a temporary registration. They cannot take ITC on any inward supplies even though they are registered and paying GST. However, they will be importing some goods. What is the goods that they will be importing? The cricket kit, etc. they will be importing. On that, whatever customs duty along with IGST paid, that IGST component alone can be taken as ITC, that is the exception. Import of goods by NRDP. Then next, food and beverages, outdoor catering, beauty treatment, cosmetic, plastic surgery, hair transplantation, life insurance and health insurance. Remember 3 terms. First food, number 2 beauty, number 3 insurance. Food to beauty insurance, food to beauty insurance. Insurance is health insurance or life insurance, and beauty treatment includes cosmetic surgery, plastic surgery, hair transplantation. Related to food, it will be food or beverages and outdoor catering. So food, beauty and insurance, these 3 are blocked credits. However, we have 3 exceptions. Inward supply, outward supply in the same category. For example, I am into the business of buying and selling of food and beverages, I can take ITC with respect to that. Number 2, inward supply, part of composite or mixed outward supply. That is, for example, if there is a airline which is providing transportation of passengers and they need to provide food and beverages to their passengers, for that purpose they buy the food and beverages. So inward supply is food and beverages, which is a part of the outward supply food and beverages. Definitely they can take ITC. That part need not be completely independent, or it can be in the part of composite or mixed outward supply, and if it is provided by employer to employer under statutory obligations, as per Factories Act, they have to mandatorily provide food to their workers who are working in the shifts. So therefore, company has received outdoor catering services. Can they take ITC? Yes, because it is under a statutory obligation. Then all other balance cases, from a person opting for composition scheme, first of all, a person opting for composition scheme should not charge GST. Even if they charge GST, we cannot take ITC. And even purchased goods for personal consumption, ITC not available, or any goods purchased which is used in relation to CSR obligation. So CSR obligation, if they purchase, even though it may be business expenditure, but ITC is not available. Goods lost, stolen, destroyed, written off or disposed of by way of gifts or free samples, that is also ITC not available. But in this regard, you have to remember one exception. If that gifts or free samples constitute supply, then definitely we can take ITC. When gifts or free samples constitute supply, number 1, if there is an employer who is purchasing a phone and giving it as gift to the employee, and the value of the phone is more than 50,000 rupees. So if the employer gives to employee more than 50,000 rupees, definitely it will become supply under 71C in the hands of the employer. Now the employer can take ITC on the mobile purchase. So therefore, at the time of purchase of the mobile, whatever GST is paid, that can be taken as ITC. That is what, even though it is distributed as gift, but as the gift constitutes supply, ITC will be available. One more scenario is that if there is any product which is given as a gift along with the other product as a sales promotion, for example, if you buy Boost, one bat will be given for free. Now in this case, this bat which is purchased by them, by the company, can they take ITC? Yes, because the free product which is given along with the other product, these two will be taxable as a single unit, either composite supply or mixed supply. So due to that reason, the free product which is purchased definitely can be taken as ITC. One more example is Kinder Joy. In case of Kinder Joy, they will buy the toy and they will affix it along with the chocolate and they will be giving it. Now in that case, the chocolate and the toy will be taxable as a composite supply. So that for the toy purchase can be taken as ITC. That is this point. If gifts or free samples is treated as supply under 71C, then ITC not required to be reversed on the inward supplies. Then previously one restriction was there. That restriction was if there is any GST paid under 73 or 74, that ITC is not available like that. But now it is irrelevant because we don't have 73. First of all, they have omitted that. And 74 also they restricted up to 23, 24, that is not applicable now. So which means that that point is completely omitted. Moreover, whenever the GST is paid under 73, 74, now it is 74A, it will never be reflected in 2B. If it is not reflected in 2B, we will not be able to take ITC because that is a connection related to this. For your exam, you have only 74A. 73, 74 up to September exam only you need to prepare. So now for January exam, you can safely omit 73, 74. You can focus only on 74A. Already last attempt they have asked 74A one question. So therefore that same question I don't think so it will be asked. But connecting to 74A along with other points they can be testing in exam. Maybe in MCQ they will be testing. I don't think a standalone question will be coming on 74A this time. Next, whether ITC available on goods purchased for free replacement during warranty period. ITC definitely available, because that particular product which is replaced during warranty period is part and parcel of the business expenditure, and nowhere it is given in the blocked credit, and it is used in the course or furtherance of business. So that, for example, if I am purchasing a part and I am replacing that part during warranty period, I can take ITC on the part purchase without any restriction. And for that replacement, I may charge GST, or I may charge consideration, or I may not receive any consideration. That is irrelevant. Just because I am not receiving consideration, don't invoke 71C also. So 71C says disposal of business asset on which ITC avail. For example, first I am purchasing the part. On purchase of the part, am I selling this part? No, I am doing free replacement. Then on the part I will take ITC. So therefore, won't it come under disposal of business asset? This part is my business asset. Won't it come under disposal of business asset on which ITC avail? No. So don't invoke 71C. That's what this circular says. This circular is concluding about 2 points. Point number 1, if you are buying any part or any goods which is given as a free replacement during warranty period, you can enjoy the ITC on the part or goods purchase. Number 2, just because it is given for free replacement, don't invoke 71C and don't make it as supply. That is this. Whether a part or entire product is replaced during warranty, ITC can be availed on the goods purchased for warranty, irrespective of whether any consideration is charged or not with respect to such warranty repairs. Where a distributor uses his stock for replacement. For example, you are a distributor, you are replacing that particular part out of your stock, and now I will replenish the stock. So means I will be sending that item to you, that part to you. Now in that case, will it become any supply in my hands? No. So therefore that should be under the cover of a delivery challan. So where distributor uses his stock for replacement, manufacturer replenishes the stock on which manufacturer can take ITC. Then next one is related to the extended warranty charges. Extended warranty charges, remember, at the same time of purchase of the main product, if you are giving it to the same dealer, it will be treated as deemed as composite supply, and the rate applicable to the main product should be taken. For example, you are buying a TV, the TV rate is 28%, and there is a warranty charges. That extended warranty charges is 18%. But if you are paying that extended warranty charges at the same time of purchase of TV to the same dealer, then for warranty charges also the rate applicable to TV only will be taken, that is 28%. In all other cases means from the same dealer different time, or from the at the same time different dealer, or from different dealer different time. In all these 3 cases, the extended warranty charges will be treated like individual transaction, and the rate applicable to warranty will be taken, that is the general rate of services, which is 18%. So amount paid for extended warranty taxable at the same rate applicable to goods if the warranty is taken from the same supplier at the same time of purchase of goods. If the amount for extended warranty is paid to another supplier, it is treated as separate supply. Also, if the amount paid for extended warranty after purchase of the goods, then also it is treated as different supply, whether it is purchased from same supplier or different supplier. With this 17 over, and 18, we have 18.1. 18.1 talks about availment of ITC on closing stock. There are 4 situations where we avail ITC on closing stock. That is, if a person is liable to get registered and he make application for registration within 30 days. Very important point is that he should make application for registration within 30 days. Number 2, 18.1b, that is a person who is voluntarily getting registered. 18.1c, he is under composition scheme, now he is moving on to normal scheme. And 18.1d, a registered person whose exempted supply became taxable. And the difference between 18.1a 1b is that 18.1a 1b situation only difference. 1a they are able to get registered and they make application within 30 days, but 1b just voluntary registration. Whereas 1c 1d, the difference is that composition, C for composition scheme. So composition scheme to normal scheme, the registered person who was under composition scheme moving to normal scheme. 18.1d, a registered person whose exempted supply became taxable, that situation difference. And 18.1a 1b, if you see, so they can take ITC on inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock, and capital goods they cannot take ITC under 18.1a 1b. And here matching is also not required. And which date closing stock should be taken? In case of 18.1a, immediately before the date they are liable to register, whereas 18.1b, immediately before the date they got the certificate of registration. Whereas 18.1c 1d, they can take ITC on inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock. Even on capital goods they can take credit. And in case of 18.1c 1d, there is matching that is required. And in case of capital goods, how much credit they can take? Total GST paid minus 5% for every quarter or part thereof from the date of purchase till the date of conversion, that can be taken as ITC. And which date closing stock should be taken? In case of 18.1c, immediately before the date of conversion from composition scheme to normal scheme. 18.1d, immediately before the date of conversion from exempted supplies to taxable supplies, that should be taken. And next, the there is a time limit in this case. In all the above cases, the closing stock including the capital goods should be purchased within 1 year prior, which means the date of invoice to the date of closing stock, it should be within 1 year. And ITC with respect to GST paid on inputs can always be availed as ITC, no restriction. But in case of capital goods, after reduction of 5% for every quarter or part thereof from the date of purchase till the date of migration or conversion, and they need to make an electronic declaration in form GST ITC 1, and that declaration should be filed within 30 days from the date they are eligible. In case of 18(1)(a), whenever they get the registration certificate, 18(1)(b) also whenever they get the registration certificate, 18(1)(c) and 1(d) whenever there is a conversion from the date within 30 days, and this 30 days can be extended for a further period by the commissioner. What is the form? ITC 1 form. This ITC 1 form should be duly certified by a CR CMA if the claim of ITC exceeds 2 lakh rupees. If the claim does not exceed, ITC claim does not exceed 2 lakh rupees, it will be self declaration. That is this point. Then 18 subsection 3 talks about transfer of ITC. So whenever there is a transfer of business with specific provision for transfer of liabilities, means both assets and liabilities should be transferred. That can be under any change in constitution of business. It can be sale, merger, demerger, or any other business reorganization. Business transferred, even ITC also will be transferred from the transferor to the transferee, and the transferor is required to file one form. What is that form that is required to be filed? ITC 2 to transfer the ITC, and this ITC 2 should always be certified by a CSCMA. What is it they need to certify? That this particular business is transferred with specific provision for transfer of liabilities. And in case of demerger, from single unit it will be demerged into 2 units. Say AB Limited is demerged into A Limited and B Limited. Then in that case, what ratio should be followed? The assets ratio should be taken. Assets ratio as on which date? Asset ratio on the date of demerger should be taken for the purpose of dividing the ITC between the 2 entities. For example, A Limited assets is 30 lakhs and B Limited assets is 20 lakhs. In 3:2 ratio, the ITC should be shifted to A Limited and B Limited. This in case of demerger, and it is not the net worth, it is the total assets that should be taken, not the net worth. And next we have single registration to multiple registration. When a single registration is getting divided into multiple registration, even then the ITC from the single registration can be taken to multiple registrations. For that, what is the form that is required? ITC 2A. ITC 2A is the form. So when there is a change in constitution of business, very important point, with specific provision for transfer of liabilities, ITC can be shifted. ITC 2, CACMA certificate, demerger, ITC transferred in assets ratio, and that assets, whether ITC availed on that assets or not availed on the assets post demerger. And even this also includes change in constitution of business due to death of sole proprietor. Sole proprietor is dead and the successor has taken, then also this ITC can be transferred. But there is one important point, that is transferor and transferee should be in the same state. For example, transferor is in Tamil Nadu and the transferee is in Maharashtra. Definitely ITC cannot be transferred. So transferee should also be registered in Tamil Nadu, then only the transfer is possible. So transferor and transferee should be in the same state. Then this is the point, when a single registration is getting converted into multiple registrations. So far the ITC was in single registration, now that will be shifted to multiple registrations. And what is the ratio of turnover to be taken? So we need to take turnover ratio. No, it is the assets ratio only that should be taken. Assets ratio as on the date of registration of the new units you need to take. Remember, for the purpose of this distribution of ITC, it is not the turnover ratio, it will be the assets ratio. Only in case of ISD it will be taken turnover ratio. Even in case of exempted, common credit, etc., also we will take turnover, but here we need to take assets ratio. Then also ITC against a single registration can be distributed to multiple registrations using ITC 2A. Asset ratio as on the date of new registration should be considered for this purpose. ITC 2 should be certified by CACMA, but ITC 2A need not be certified by CACMA. In case of demerger, we need to see the balance in ITC as on the date of transfer. As on the date of transfer, whatever balance in ITC that should be taken. For example, demerger happened 3 months before, but today we are doing the transfer. So today whatever is ITC balance that should be taken, but the assets ratio as on the demerger date should be taken. That is as on the demerger date, that is 3 months before whatever was the assets that should be taken. And in case of ITC 2A, there is a time limit. ITC 2, there is no time limit. For ITC 2, there is no time limit. For ITC 2, there is no time limit, but in case of ITC 2A, there is a time limit, and that time limit is within 30 days from the date of new registration. Within 30 days from the date of, within 30 days from the date of new registration. Within 30 days from the date of new registration, there is a time limit for ITC 2A, but for ITC 2 there is no time limit, you can file any time, but 2A alone within 30 days from the date of new registration this form needs to be filed. Next we have 18.4 and 29.5, that is reversal of ITC on closing stock. So whenever you are going into composition scheme, this is opposite of 18.1C, 18.1D. So you were in normal scheme and you are going into composition scheme, or your taxable supplies became exempted, or your registration got cancelled. In all these three cases you need to reverse ITC on closing stock. We need to see whatever is the input as such held in stock, input in WIP held in stock, input in FG held in stock, whatever ITC we avail that will be reversed. Whereas in case of capital goods, ITC needs to be reversed, but here it is not 5% point, it will be total ITC divided by 60 months into balance useful life. So we need to take that way in order to reverse, and this is common even for cancellation of registration. But remember one point, for cancellation of registration we need to compare it with the transaction value, that is value of such inputs or capital goods at the time of sale. Suppose if such capital goods or inputs are sold, whatever may be the value, that value should be taken, and we need to compare with this whichever is higher. For example, the capital goods total ITC divided by 60 into balance life, or if the capital goods are supplied, they are not selling it, but if the goods are supplied, then they need to see whatever is the GST payable on that capital goods, whichever is higher should be taken. But this is applicable only in case of cancellation of registration. But in these first two cases, normal, whatever ITC availed that needs to be reversed. Then inputs and capital goods can be purchased at any time on which ITC is availed. If ITC not availed on that inputs and capital goods, then reversal shall not arise. Also, if the capital goods are purchased 5 years before, now there is no balance life, so reversal of ITC shall not arise. If ITC, like if suppose invoice is not available, say we need to reverse the ITC on the inputs, but invoice is not available, then we can take the market value. If invoice pertaining to such inputs not available, then the market value as on 31/3, that is this date, whatever market value is there that can be taken. And whenever they are taking market value, then they need to get a certificate from CRCMA related to that market value, and all these details of reversal needs to be reported in ITC 3. Suppose if the ITC to be reversed is 1,50,000, but the balance in ITC is 2 lakhs, so 1,50,000 will be reduced from 2 lakhs and the remaining 50,000 will be lapsed. Suppose if the reversal ITC will be 1,50,000, but the balance is only 1,20,000, we will adjust from 1,20,000, the remaining 30,000 we need to pay by cash. That is this. If there is a balance in ITC after reversal, it shall be lapsed. If there is any shortfall for reversal, that shortfall shall be payable using cash ledger. Computation to be made separately for CGST, SGST, UTGST, IGST. This is GST payable under section 18.6. Remember, when 18.6 is applicable, first it should be capital goods. Capital goods means those goods which are purchased and capitalized in the books of the person who is purchasing it. Number 2, ITC should be availed on that capital goods. Number 3, that capital goods should have been supplied. So in these cases only 18.6 will be applicable. All the three conditions should be satisfied. First, capital goods are purchased on which ITC is availed and that capital goods are supplied. What will be the GST payable? ITC availed minus 5% for every quarter or part thereof. We need to count not from the date of availment of ITC, but we need to count it from the date of invoice. From the date of invoice, not date of availment of ITC. For example, invoice is 23rd March, but the ITC is availed on 20th of April. So don't count it from April, you count it from March, means 1 quarter extra we will be getting. So ITC minus 5% for every quarter part from the date of invoice till the date of supply, or GST payable on the value of such capital goods. Suppose if the capital goods are supplied, but it is 7.1C, then there is no consideration. Then we need to determine the value as per rule, that is either rule 30 or rule 31. That should be given in the question. Based on that, suppose if the question is silent about this, only A point will be there, B point will not be there. And this section is not applicable in case of 3 goods, that is refractory bricks, molds and dies, jigs and fixtures, which are sold as scrap. That is important. Not just refractory bricks, molds and dies, jigs and fixtures. Only when it is sold as scrap only, we will not be taking this 18.6. And in that case, what we will do, we will just take GST on the sale value of that scrap. That is only to be taken, and this A point will not be applicable in that case. Then job work provisions, section 19 read with section 143 of CGST Act. In case of this job work, so our principal should be registered person, then only both the sections, section 19 and 143 will be applicable. There is a principal who owns the goods and he will be purchasing the inputs and capital goods, that is step number 1, and on those inputs and capital goods the principal will take the ITC, and those inputs and capital goods will be sent to the job worker for processing. At the time when he is sending it to the job worker, he is not required to reverse any ITC, because whatever ITC which has been taken, that will be intact and he is not required to reverse any ITC, and thereafter job worker has to process this and he need to return the processed goods within 1 year, and it can be extended for a further period of 1 year, and in case of capital goods it should be returned within a period of 3 years, and it can be extended for a further period of 2 years. So in processed goods 1 year plus 1 year, capital goods 3 years plus 2 years, that is the time limit within which the goods should be returned. However, in case of 3 goods, that is molds and dies, jigs and fixtures and tools, not refractory bricks, molds and dies, jigs and fixtures and tools, there is no time limit not applicable in this case. And suppose if the job worker is not sending this to the principal within the time limit, then what will happen? Then it will be deemed as supply in the hands of the principal on the day it is sent to the job worker. So means after 1 year plus 1 year, after 3 years plus 2 years, it will be treated as supply backwards at that time. So now we need to pay along with interest. So on the date of, it is deemed as supply under section 19 on the date of dispatch to the job worker. If the goods are directly received by the job worker from the supplier of the principal, the date of receipt by the job worker. If the principal is sending it, so we need to take that as the date on which supply has been made. Suppose means this 1 year or plus 1 year, 3 years plus 2 years should be counted from which date? Suppose if the principal is sending it to the job worker, from the date of dispatch to the job worker. If the job worker has directly received the goods, from the date of receipt by the job worker, that is this. So if the goods are directly received from the supplier or principal, then the date of receipt by the job worker is deemed as supply. Next, this principal has to file form GST ITC4. That ITC4 is with respect to goods sent on job work and received from job work. What is the frequency of this ITC4? If the aggregate turnover during previous year does not exceed 5 crores, they have to file it yearly only once by 25th of the month following every year. So that is by 25th April they need to file. Whereas if their aggregate turnover exceeds 5 crores, then they have to file it half yearly. For the first half year from April to September by 25th of October. For the second half year from October to March, that will be by 25th of April. But this form need not be certified by a CRCMA, just the form needs to be filed by this time limit. And such goods should be sent to job work under the cover of a delivery challan and e-way bill. E-way bill always mandatory in 2 cases. Whatever may be the value of goods, e-way bill is mandatory. Number 1, goods sent on job work, and number 2, handicraft goods. So this is goods sent on job work, so e-way bill always required and delivery challan is required. Even if goods are directly received by the job worker, ITC can be taken by principal under that bill to ship to model, deemed delivery model. Job worker can take ITC with respect to his inputs and input service used in processing, provided the job worker is registered. If the processed goods or capital goods are returned after 1 year or after 3 years as the case may be, then it will not be treated as reversal of ITC etc. and all. So it is treated as a new supply made by the job worker to the principal. So if the processed goods or capital goods are returned by the job worker after 1 year or 3 years, it is treated as new supply by job worker and chargeable to GST, which can be availed as ITC by principal. If the job worker is not registered, the principal should declare job worker's place as his additional place of business. That is also an important criteria. Provided the goods are supplied from the job worker's place. If I am the principal, you are my job worker, I am going to sell the goods from your place and you are unregistered person, then I have to show your place as my additional place of business. And jurisdiction officer must be intimated about the job work contract, and the processed goods can be brought back to the principal's place, or it can be sold from the job worker's place or exported from the job worker's place. Then we have section 20 and 21, input service distributor. Somewhere I have a gut feeling that this time you will definitely get a question on input tax credit. Open challenge, it will come. Okay, it will come, mark my words. So this attempt, Jan 26, there will be one question for 5 marks on input service distributor concept. Okay, so just trust me, it will come. So ITC, this input service distributor, as per section 20 and 21 of CGST Act, there is a ISD. That input service distributor will receive the invoices, basically a head office or a corporate office or administrative office. They will receive the input services and they will pay GST, take the ITC and distribute it to all the divisions or branches below them. And on what ratio they will distribute? On the turnover ratio. So that is what ISD is about. but remember ISD is required to get a separate registration. For example, I already have a branch in Tamil Nadu, but I have a corporate office in Tamil Nadu. Even then I need to get a separate registration as a ISD. For the branch anyhow I have a GSTIN, but as ISD it is a different registration because ISD will file only one return, that is GSTR6. So due to that reason separate registration is required for them. And CGST, SGST distributed as CGST, SGST for the unit in the same state. For example, the head office is located in Tamil Nadu and division 1 is also located in Tamil Nadu. Then CGST credit will be distributed as CGST, SGST will be distributed as SGST, IGST will be distributed as IGST. But suppose if the division is in another state, then CGST, SGST, IGST, everything will be accumulated as IGST and it will be distributed as IGST. So CGST, SGST distributed as CGST, SGST for the unit in the same state of ISD and distributed as IGST if the unit is in the different state than that of ISD. And suppose if the service is attributable only to one unit, so if the service is used only by division A, then the entire credit will be given to division A. If the service is attributable to two divisions, then it will be given to two divisions in their turnover ratio. What if it is common? It will be divided to all the divisions. So all the units which are operational based on the turnover ratio. And which turnover should be taken? Either take the previous year turnover. If the previous year turnover is not available, maybe because they are not operational during the previous year, then take the previous quarter turnover based on the availability. And remember ITC to be distributed on a monthly basis. That month ITC should be distributed in that month only and there is no possibility of accumulation. For example, April, May and June I cannot accumulate and thereafter transfer to the divisions. So that monthly ITC should be distributed in the same month. And how this ITC will be distributed? They will be giving a ISD invoice and all those ISD invoice should be reported by ISD in GSTR6. That should be filed by 13th of the month following every month, and this data will be reflected in 2B of the recipient units on 14. And even blocked credit, ineligible credit, everything should be distributed. So ISD cannot decide as to what is blocked credit, what is ineligible credit, etc. ISD should distribute each and every input service to the divisions, and the divisions then decide whether it is a blocked credit or used for non-business purpose or used for exempted. The T1, T2, T3 calculation will be done by the divisions. It is not done by the ISD. So every credit should be distributed. And that is to be done in GSTR6 by 13th of the month following every month. Excess distributed ITC can be recovered by issuing ISD credit note. So they can give a ISD credit note. For example, I have to distribute 20,000 to one division, but I distributed 30,000. So I need to reduce the 10,000. So ISD can give a credit note. And for another division which there is a shortfall, they can give a ISD invoice for the purpose of either ISD debit note or ISD invoice for the purpose of distribution. So that is this. So shortfall in distribution can be distributed using ISD invoice. Distributed credit should not exceed the credit available. For example, if the credit available is 1,20,000, the total of the distributed credit should also be 1,20,000 or less than that only. If the ISD has distributed excess credit to any recipient, the excess will be recovered from the recipient only, not from the ISD. As if the recipient has not paid the tax, short payment of tax, it will be recovered from the recipient unit along with interest and applicable penalty. So 74A provisions will be applicable in that case. ISD should obtain a compulsory registration irrespective of their aggregate turnover, and this is one latest amendment for JAN exam. Even GST paid under RCM also can be taken as ITC and that can be distributed. But what if one division takes the pay the GST under RCM? Please concentrate. Suppose if the head office is paying the GST under RCM, if they receive advocate services, the corporate office received the advocate services. Advocate service will be common for the entire organization. So they paid GST under RCM. That credit also they can distribute it to all the divisions. And suppose if a particular division has paid the advocate service charges, but that particular advocate services is common for the organization, but one division has paid, then the division should raise invoice to the head office and the head office will in turn distribute the credit to all the branches. This is the latest amendment. That is, even GST paid under RCM can be availed as ITC by ISD and distributed to divisions. What if one division has paid the GST under RCM? They have to in turn transfer that ITC to the head office and thereafter the head office will distribute it to all the divisions. Just keep that in mind. While computing the turnover, so three places we have come across the turnover. One is Rule 42, another is Rule 43 and yet another is the Section 20 ISD. Rule 42, 43 and Section 20, we should not take old indirect taxes like central excise duty, state excise duty, CST and VAT should not be taken. Actually, this is contravention of 15(2)(a). 15(2)(a) says taxes, duties and cess by whatever name called other than GST should be included in value, but it says that the old indirect tax should not be included in the value. While computing the turnover under 42, 43 or 20, old indirect taxes like excise duty, sales tax and value added tax should be excluded. Also, value of supply of duty credit scrips should be considered as taxable turnover. This already we discussed it long back, and previously we had cross charge, but that is now omitted. So that is also another amendment for your exam. Now there is no possibility of cross charge. Mandatorily with effect from 1/4/2025, ISD only should be followed when there is a head office and divisions and the invoice is raised to the head office. They have to distribute the credit to all the divisions using ISD route only, and this cross charge like one division raising invoice to another division is not allowed now because they have made it mandatory and cross charge cannot be followed now. Then one more point in this regard is that inputs and capital goods credit cannot be distributed. Only input services credit can be distributed because the heading is input service distributor, not input distributor or capital goods distributor. So suppose if there is any person who raises the invoice to the head office for the goods which are supplied to the division, can the head office distribute the credit? No, not possible. Then that supplier should raise a credit note to the head office, and thereafter they need to raise invoice to that branch to which they are sending the goods. So therefore this distribution of credit through ISD route is not possible for inputs and capital goods. Only for input services it is possible. So that is with respect to this ITC. So we completed fully all the points, but ISD alone please mark as important. High chance is there that it can be tested in exam. So next we are now moving on to this offences, penalties, search, seizure, etc. So in this we are going to understand few branches. That is, first we are going to see what are the offences. What are the offences? See, this chapter actually it seems very big, but it is not that big. So hardly we can complete it in 1 hour also. Okay, so just focus. So offences, first we need to understand what are the offences that leads to search and seizure. That is the first aspect we need to know. Then we need to know what are the offences that leads to penalties. And next we need to know what are the offences that leads to imprisonment. And then we need to see what are the offences that leads to cognizance, that is cognizable versus non-cognizable. Also we need to know what are the offences that leads to arrest, and finally we need to know what are the offences that leads to compounding of offences. So first is search and seizure. So this search and seizure is given in 2 sections. So there are 2 situations. Section 67 read with section 130. You have to remember these sections. Section 130, and second one is section 68 read with section 129. Section 67 read with section 130, search in the premises, and section 68 read with section 129, search during the transit. And all the penalties will be section 122 to section 125 up to general penalty. Then arrest is given in section 69, and imprisonment is given in section 132, and cognizable versus non-cognizable is also 132 only, and compounding of offences is section 138. So these are the areas. Out of these 1, 2, 3, 4, 5, 6 branches, any one will definitely be asked. Repeatedly they are asking one question. So last attempt it was 129 penalty. So owner come forward, owner does not come forward, like that. So before that they will be asking on imprisonment. Before that it will be compounding. Out of these 6, one question guarantee pa. If not, you return the paper and come back. That is not CA final IDT paper. Okay, so that much guarantee that one question out of this will be tested in exam. Okay, so what is the offences that leads to search and seizure we are going to discuss. Situation number 1. So two situations I told you search will happen. One is section 67 read with section 130. Basically what happens here, they will be visiting our premises, and in our premises they will be verifying for any goods which are liable for confiscation. When the goods are liable for confiscation, if we have not maintained proper documentation with respect to that goods, then the goods are liable for confiscation. They will conduct the search, and even they will seize not only those goods, even the documents which contains the details of the goods which are liable for confiscation. So they can seize goods, they can seize documents, they can seize things. Things refers to hard disk, computers, even cash also can be seized during the search operations. Inspection was carried out at the premise of the taxable person or transporter. They did not use the word registered person, they use the word taxable person. So who is a taxable person? A person who is registered or liable to be registered at the premises of the taxable person, or even transporter and warehouse operator, or any other premises. Even residential premises also can be verified if they have reasons to believe that in that residential premises they have secreted some documents or goods that is liable for confiscation. And authorization from Joint Commissioner above is required for inspection. That authorization is called as search warrant. So the search warrant is required, but it is not called as warrant, it is called as authorization from the Joint Commissioner or above. And if any unaccounted goods are found, the goods are liable for confiscation. And first what they will do the seizure of goods. The moment they seize the goods, the possession will be transferred to the government. The ownership is still with the taxpayer only the possession will be transferred. The seizure is from the place of business, and they will pass a seizure order. So seizure order for goods or documents shall be passed. Against this seizure order, there is no appeal that is possible. Keep this in mind. Against seizure order, we cannot file an appeal. Also for seizure order, there is no notice that is applicable. Okay, no notice, no opportunity of being heard. Directly they will do the seize. So notice is also not applicable for seizure order, and appeal also you cannot make against the seizure order. Then after seizure order, you have only two options. Option 1, you give tip, that is tax, interest, penalty. Okay, you give the tip, tax, interest, penalty. Tax, whatever is the tax applicable on the goods which are unaccounted. Then interest as applicable. Penalty, what is the penalty? 122 subsection 1 penalty, that is 100% of the tax evaded or 10,000, whichever is higher. Remember, in three places you need to do always CGST, SGST computation. That is interest, wherever, not interest, this penalty, wherever penalty comes. Number 2, pre-deposit, and number 3, late fee. Only in three places in the entire GST law we need to do separately for CGST and SGST. So first is penalty, number 2 is pre-deposit, appeal pre-deposit, number 3 is late fee for delay in filing returns. In these three places. And be careful with respect to the question. If the question says compute penalty, so which means that you need to do it as per CGST, multiply by 2, because they are asking penalty, not under CGST. Penalty means total penalty. So therefore you always do as per CGST. If the question is as per CGST Act, means that alone you write. Suppose if the question is as per IGST, multiplied by 2 and write. Suppose if it is without any act, just they use the word penalty, then also you multiply by 2 and write. Is it clear? So only 3 answers you will be writing, any of these 3 answers. Suppose if the question says penalty under CGST Act, you do only as per CGST Act, that only you will write. Suppose if they say penalty or penalty under IGST Act, then what you need to do, whatever penalty you compute under CGST, that multiply by 2, that you need to write as the answer. Mainly in MCQs they will play with you. So they will give CGST penalty also, multiplied by 2 also will be given. So now you will not know which one to be written as the answer. Check for the question. If the question says penalty as per CGST Act, then only that CGST Act penalty needs to be selected in the option. So that is this. So in case where the seizure order is passed, you have option 1, pay appropriate amount and get it released. What is that appropriate amount? Tip, tax, interest and penalty, and the penalty will be under section 122 subsection 1. What will happen once you pay this? The goods will be released and all the proceedings in this respect shall be deemed to be concluded. Or option 2, you don't have money to pay the tax and penalty now, you can execute a bond. But when you execute a bond, the proceedings are not yet completed because you did not make any payment, just the bond is executed. So there will be provisional release of goods by executing a bond covering the value of the goods. And if you are not exercising both these options, thereafter they will pass a confiscation order. The moment they pass a confiscation order, the ownership also will go to the department. And whenever they pass confiscation order, still you have an option to get your goods, for which you need to pay a fine. So now you need to pay TIPF. So tax you need to pay, interest you need to pay, penalty you need to pay, and fine also you need to pay. What is that fine? For release of goods, the maximum fine will be the market value of such goods minus tax payable thereon. That is a maximum fine. Maximum fine is tax payable on such goods. You should ascertain and see the market value of the goods. Market value of the goods minus tax payable thereon. That difference is the maximum fine for release of goods. And even for conveyance you need to pay a fine. So because if there are some goods, that goods are loaded in a truck and that truck is in the premises, so they will seize the truck also. So then for release of the truck, what is the fine that you need to pay? The maximum redemption fine for release of truck will be the tax payable on the goods which are present in the truck. So on the goods which are present in the truck, some tax is payable, that should be taken. That is this redemption fine in case of goods and redemption fine in case of conveyance. So this is maximum redemption fine. So maximum fine equals to market value of goods minus tax chargeable. For conveyance, tax payable on the goods transported thereon. What is the time limit within which this fine needs to be paid? Within 3 months from the date of confiscation order you need to pay, so that the goods will be released. Suppose if you have not exercised this option 1 and option 2, thereafter after confiscation order also you did not pay this redemption fine, then what will happen? So confiscation order already passed, the ownership is now with the government, they will do the auction and they will dispose of those seized goods, and whatever proceeds that is realized, will it be retained completely by government or it will be refunded to the owner of the goods? There is no owner of the goods here. The moment confiscation order is passed, the government itself is a owner, so therefore completely it will be retained by the government. So tax and penalty payable along with the redemption fine. If option not opted, then confiscated goods shall be disposed of. Entire amount will be retained by the department. So these are the points you need to remember. So this area, so quite a long time they have not tested this redemption fine. So last 4 attempts they have not tested this. What is the redemption fine for release of goods and release of conveyance has not been tested, along with this 3-month time period also. Okay. So possible that they can be asking this question on confiscation. And inspection can be carried out only after a joint commissioner or above officer gives authorization. So therefore warrant is required, or such warrant is required. Without that it is not possible. And before issuing authorization, officer should have reason to believe that the taxable person has suppressed the transaction. So this is also important. So when the officer can order for inspection, first the officer should have reason to believe that really there is a suppression of transaction or suppression of stock, or they have claimed ITC in excess or any other contravention. Then after seizure, one notice has to be given specifying the amount of tax, interest and penalty payable. So that notice should be given within 6 months from the seizure order, and it can be extended for a further period of 6 months, useful for MCQ. Suppose if they have not given the notice within 6 months plus 6 months, then the goods should be released, because they have to give the notice, otherwise how we will be able to make the payment. So after seizure order, notice for payment within 6 months plus 6 months. If no notice is issued, goods shall be returned from the person from whom it is seized. That is with respect to this situation 1 of search and seizure. Section 67 read with 130. Then next one, we have a difference between access to business premises versus inspection under section 67. So access to business premises is like a softer provision for inspection. So before inspection, first they will do the access to the business premises. What is the place where they will do access to business premises? Only business premises, only place of business. But here either business premises or residential premises or warehouse or transporter premises or any other premises. And under section 67, who is the person covered? Taxable person, operator of warehouse or transporter, but here only registered person. Warrant here definitely required to be issued by officer not below joint commissioner, but here no need of any warrant. Randomly they can come to our premises, but only thing is that so they should be an authorized officer. The officer should be an authorized officer, not required, but officer authorized by an officer not below joint commissioner. Reason to believe evasion. So in case of section 67, proper officer has reason to believe that the tax is evaded, but in case of 71 it's not required. So because it is just a random exercise, that is not required. Again, this is an area which is not tested in exam so far, but it is there in the study material. They can be making a question on this. Usually access to business premises is carried out to gather the evidence for inspection under section 67. Then So following records are to be made available. So whenever there is an audit which is conducted by the department or by the audit party, that is chartered accountant or cost accountant, or it is access to business premises, in all these cases they should be giving us a prior notice to submit the documents. What is the notice within which they need to submit the documents? So they need to give a notice, and that notice should be within 15 days we need to submit the documents. So a record should be made available within 15 days from the day when the demand is made. Means notice should be given asking for documents, within 15 days we need to produce that, and it is also applicable in case of special audit under section 66. What are the records that we should make available? All the records which are maintained under section 35. What are the records maintained under section 35? I formats. I for inward supplies, F for foreign trade, that is import and export related records, O for outward supplies, R for RCM purchases, IFOR, M for manufacture and production related records, A for advances received, paid and adjusted, T for tax details, input tax and output tax, last S, that is stock details. These are the accounts and records which should be made available under section 35. Then trial balance or equivalent, then audited financials, cost audit report and income tax audit report. Then they can take the assistance of the following officers under section 72. So they can take the assistance of police or railways or customs or village officers or officers in charge of collection of land revenue, that is this mandal revenue officers will be there na. So their support also can be taken when they are going for the search into the business premises. All these officers, any of these officers assistance can be taken by the GST officer. Then second situation, seizure of goods during the transit, that is section 68 read with section 129. I don't think so that is this much important, because already it has been tested, but maybe in MCQ somewhere it could be connected. So this is basically a conveyance which is carrying the goods, is intercepted by the proper officer, and the proper officer is verifying whether there is proper documents available, that is e-way bill, invoice, etc. Suppose if there is no proper documentation, then the goods are liable for confiscation. Then not only the goods but also the conveyance which is taking the goods will be seized during the transit. So conveyance carrying the goods are intercepted by proper officer if the transporter was found transporting or storing such goods which are removed in contravention of the provisions of the act. Such goods and conveyance is liable for confiscation as per section 29. They will do the seizure in transit. Seizure means transfer of possession to the department. What they will seize, not only the goods but also conveyance will be seized. And the moment they seize, they will be giving a notice for levying the penalty within 7 days from the seizure order. And after 7 days, within 7 days, they will pass a penalty order. First seizure order. After seizure order, within 7 days, a notice for levying penalty. But in the first situation, 6 months. But here just 7 days. Thereafter, there is no extension. But at least there, 6 months plus 6 months. Here no extension, 7 days. And once they give notice, within 7 days, they will pass a penalty order. And after that penalty order, within 15 days, we need to make the payment of penalty. Notice within 7 days. And penalty order within 7 days, and thereafter penalty should be paid within 15 days, and the set period of 15 days can be reduced in case of perishable goods. Alternatively, a bond also can be executed in this case. A bond can be executed. So therefore, if you don't have, this option is common. Even in the previous case also we have the two options. Option 1, you can pay the tax, interest, penalty, or you can execute the bond. Here also you can either pay penalty or execute the bond. Here no need to pay tax, just a penalty. So there we need to pay tax, interest, penalty, which is first situation. But in this case, just the penalty is required to be paid. There also we can execute a bond alternatively. Here also we can execute a bond alternatively. And the set period of 15 days can be reduced in case of perishable goods. Now, what is the amount of penalty? That is given in section 129. But there the penalty will be 122 subsection 1 penalty, that is 100% of the tax or 10,000 whichever is higher. But here it is not like that. If the owner of the goods come forward or the owner of the goods not coming forward, owner coming forward, owner not coming forward means transporter coming forward. So we need to again divide whether it is taxable goods or exempted goods. If it is taxable goods, then 200% of the tax, if the owner come forward, taxable goods, 200% of the tax payable on such goods. And suppose if it is exempted goods, 2% of the value of the goods or 25,000 whichever is lower. And in case of conveyance, what is the penalty that we need to pay? Whatever penalty that we need to pay for the goods or 1 lakh whichever is lower. Usually penalty provisions always will be whichever is higher, but this is the place where the penalty provision is whichever is lower. So keep that in mind. So in case of exempted goods, what is the maximum penalty? 25,000. And in case of conveyance, what is the maximum penalty? 1 lakh will be the penalty. And this is the penalty under CGST Act. The same penalty will be payable under SGST Act also. But you remember CGST Act penalty and you know how to answer it whenever you get a question accordingly. So taxable goods, the penalty will be 200% of tax payable, exempted goods 2% of the value of the goods or 25,000 whichever is lower. And for release of the conveyance, penalty will be penalty for release of goods or 1 lakh whichever is lower. Suppose if the owner is not coming forward to claim release, that is transporter is coming forward to claim release. In case of taxable goods, the penalty will be 200% of tax payable or 50% of the value whichever is higher should be taken. So you need to compare with the value. But again I am repeating, this is the penalty under CGST Act, which means an equal amount will be payable under SGST Act. So it will become 100% of the value because 50% of the value under CGST, 50% of the value under SGST. So therefore 200% of the tax or 50% of the value whichever is higher. Sir, always it will be 50% of value only will be higher now, sir, because the maximum rate of GST is 28% and half of that will be, that is CGST will be 14%, 14% into 200% will be 28% only. So 28 or 50%. So 50% is only high, not necessary, because we have GST compensation cess also. If you add GST compensation cess and all the taxes, then it may happen that the 50% of the value is less than the 200% of tax also. So that's the reason why you need to remember this like this and write it like this only. 200% of tax or 50% of the value whichever is higher, not whichever is lower. This place it is whichever is higher. Whereas the other two, exempted goods 5% of the value or 25,000 whichever is lower. And even in case of conveyance, penalty payable for release of goods or 1 lakh whichever is lower should be taken. Then what will happen within 15 days if the penalty is not paid? So they will dispose of the goods, and in case of perishable goods they can dispose of immediately also within that 15 days. And when they dispose of the goods, what they will do with the money? So the money will be, here there is no confiscation order, so they are disposing of even without confiscation order. So therefore the money they cannot retain definitely, so they have to return it to the owner of the goods. But in the previous case confiscation order is passed, so the money will be retained completely by the government, but here money cannot be retained by them, they have to return it. So first it will be apportioned towards the expenses. So for conducting the auction there will be some expenses, towards that they will recover. Thereafter they will recover the penalty that is payable on that goods, and then the tax etc. that is payable on the goods. Whatever balance if any, that will be returned to the owner of the goods. If the owner is not coming to claim that particular refund, they will wait for 6 months and thereafter they will put it in the consumer welfare fund. It so happens that as soon as the driver is caught, he may jump and run away. So then in that case they don't know to whom they need to pay the refund, so they will wait for 6 months and then it will be transferred to consumer welfare fund. That is these 4 points. First it will be apportioned towards administrative cost, thereafter amount to be recovered for payment of penalty under 129, and the balance shall be credited to electronic cash ledger of the owner of the goods or conveyance if they are registered, else it will be credited to their bank account. If the balance of sale proceeds cannot be so paid within 6 months from the date of sale, it shall be deposited in the consumer welfare fund. So we completed the first part. What is that first part? What are the offences that leads to search and seizure? The second part, what are the offences that leads to penalties? Section 122 subsection 1, there are few offences. Bio discredits TFT, and this particular offences which are committed by the taxable person. So what is that? Bio discredits TFT. B for books of accounts default. Books of accounts default means non-maintenance of books of accounts, or false books of accounts, or fake books of accounts. I for invoice default. Invoice default means I am making supply without invoice, or I am giving invoice without supply, or supply with incorrect invoice. O for obstructing an officer from doing duty. D for dealing in goods liable for confiscation, means knowing that the goods are liable for confiscation, I am dealing with those goods, either purchasing those goods or selling those goods, etc. And I for input service distributor default. S for supply with the GST of some other person. Then C for 2 points are there. Collected tax not paid within 3 months, or collected an amount as tax not paid within 3 months. The difference is simple. I am supposed to collect the tax, I am collecting the tax, but I have not paid within 3 months. That is also an offence. I am not supposed to collect the tax, but representing as tax I collected some amount. For example, I am making exempted supplies, I should not collect the tax, but representing as tax I collected, then it will be called as collected amount as tax and not deposited within 3 months. Then registration related default. Registration related default means not getting registered or giving false information for registration. E for erroneous refund. and D for disposal of goods while detention or seizure is operational. So they seize the goods, but you are breaking that seizure and you are taking those goods and you are selling it off. That is disposal while detention or seizure is operational. I for ITC default. Then T, tampering with material evidence. So they have got some evidence and you try to destroy that evidence. And S for suppression of turnover. You try to suppress your turnover. Then TDS, TCS default. Failure to furnish information or document which is asked for, and transportation related default. So bio discredits TFT. These are the list of offences, and you don't have to by heart these offences, but you should know that whether this offence is there or not, because in the question they will give situation. Based on the situation, you need to just run through whether it is there in the list of these offences. Yes, if it is there, then the penalty will be 100% of tax or 10,000, whichever is higher. So for that you should be knowing, but don't worry, if you read it once or twice, that is sufficient. No need to by heart this, because in exam, the moment you see the situation, automatically, because you are not dumb idiots, you cleared CA intermediate and you are in CA final, because the moment you read the question, it will flash in your mind that it is there in the list. You don't have to by heart about it, okay? Then next you see this, below specified offences, bio discredits TFT. So who is that person? Taxable person. And what will be the penalty? 10,000 rupees or 100% of the tax or ITC involved, whichever is higher. Always remember, penalties will be whichever is higher. Wherever it is, whichever is lower, that only you need to remember. Also many places it will be whichever is earlier. So wherever it is, whichever is later, that only you need to remember. So what you need to do while preparing, so in the book, in the last page, whichever is lower provisions alone you write separately, and whichever is later provisions alone you write separately, because usually it is whichever is earlier, because sitting in the exam hall that confusion will come. It is whichever is earlier or whichever is later, like that. So in one page when you are writing, just like a flash, so when you go to the exam, so morning somewhere like 7 o'clock you get up on the exam day, just quickly go through that so that you will not forget that. Then 122(1)(a), this 122(1)(a) is on any person, not on taxable person or registered person, any person. But what is the offence here? A person who is a mastermind behind invoice default or ITC default or ISD default, means at his instance the offence is committed, and who is beneficiary of that offence. Two words you should remember: at their instance the offence is committed. So it will be given in the question like this: instance. The moment you see the word instance or beneficiary, the words, these two words you see, definitely it will be 122(1)(a) penalty on that person. So therefore tax evaded or ITC availed or passed on. How much ever is the tax evaded or ITC? Mostly on chartered accountants or any consultants who is beneficiary of the offence or at whose instance offence is committed, this 122(1)(a) penalty will be applicable. So this is on any person who is at whose instance offence is committed and who is the beneficiary of invoice default, ITC default or ISD default. 122(1)(b), this is on e-commerce operator. An e-commerce operator is allowing an unregistered supplier to make interstate supplies through their platform, or allowing an unregistered person to make supplies through their platform without unique enrollment number. So allows unregistered supplier to make interstate supplies, allows a person opting for composition scheme to make interstate supplies, or failure to furnish correct details in GSTR 8, then there will be penalty under 122(1)(b), and this penalty is only on the e-commerce operator who is liable to deduct TCS. There are some e-commerce operator who are not liable to deduct TCS. That is section 9(5) e-commerce operator. That is HATE, H for housekeeping services, A for accommodation services, T for transportation of passengers, E for eating food in restaurant. Those e-commerce operators definitely are not required to deduct TCS. So this is not applicable for them. So this is applicable only for e-commerce operators who is liable to deduct TCS. Now there is a contradiction here. So this 122(1)(b) is on e-commerce operator. Also 122(1) is on TDS TCS default. So what is the difference between these two? Which means both the penalties will be applicable. See, both are applicable, but the situation is different. That is, e-commerce operator has deducted the TCS but not remitted, or not deducted TCS or remitted less. In that case, it will be 122 subsection 1 penalty, that is 100% of the TCS or 10,000, whichever is higher. Whereas this is only specific cases, allowing, that is procedural lapse, allowing an unregistered person to make interstate supply, allowing a person under composition scheme to make interstate supply, or not furnishing proper details in GSTR 8. So procedural lapse, that is tax lapse, TDS TCS, TCS dot by tax lapse, but it is procedural lapse. Then in that case the penalty will be 122(1)(b). But what is the penalty? Yeah, it is not 100% of TCS, 100% of the tax. TCS is just 0.5% only, but the tax will be 18% or 12% or 5%. So it is 10,000 rupees or tax involved, not TCS involved. In case of 122.1, it will be TCS involved. Be careful. Definitely in MCQ they will twist this. So you will take TCS only in this place. No, it is not TCS. It is tax involved. 10,000 rupees or tax involved, whichever is higher. Then 122 subsection 2. So this will be on a person whom now 74A is invoked. When 74A will be applicable? 5 situations: non-payment of tax, short payment of tax, wrong availment of ITC, wrong utilization of ITC, erroneous refund. Non-payment of tax, you are supposed to pay tax but you did not pay tax. Then non-levy of tax, that is non-payment of tax, short payment of tax. What is short payment of tax? That is you have paid less. You are supposed to pay some 12% but you paid only 5%. That is short payment of tax. Wrong availment of ITC, that is you have availed the ITC wrongly. Wrong utilization of ITC, that ITC you have utilized. Then erroneous refund, you are not supposed to get the refund but you got the refund. To recover this amount, they will be initiating notice under 74A. If they initiate notice under 74A, the penalty will be under this 122 subsection 2. What is that penalty? In case of fraud, collusion, willful misstatement, that is intention to evade is present, then it will be 10,000 rupees or 100% of the tax or ITC involved, whichever is higher. But in 74A, they missed this 10,000 rupees. In 122 subsection 2, this 10,000 or tax involved, whichever is higher is there. But in 74A, in drafting, they missed this 10,000. Directly they gave tax or ITC involved, no, whichever is higher is not there. So reason, anyhow, when you commit offense which is fraud, so for less than 10,000 rupees and all, no one will do the fraud. You understood? If they are doing fraud, that will be bigger. So for that reason, in 74A, they removed this word 10,000. They said 100% of the tax or ITC will be the penalty. But that both are connected only. Don't worry about it. Then suppose if it is other than fraud. Other than fraud means what is the penalty? 10,000 rupees or 10% of tax or ITC involved, whichever is higher. For example, 90,000 is the tax involved. 90,000 into 10%, 9,000. 9,000 or 10,000, whichever is higher will be 10,000. Okay. So they will be giving in question the tax evaded is 1,80,000. When they give tax evaded 1,80,000, what we do blindly? So 1,80,000 into 10%, 18,000. 18,000 or 10,000, whichever is higher, 18,000. So option A will be 18,000. Option B will be 20,000. Which is correct answer? Option B is the correct answer, not option A. How, sir? 1,80,000 is the tax. In that CGST, how much? CGST will be 90,000. Correct? 90,000. Half per half. CGST will be half. So 90,000 into 10%, that will be 9,000. 9,000 or 10,000, whichever is higher. Which is higher? 10,000. What I told you, you need to multiply by 2 for the total penalty. So 10,000 into 2, that is 20,000. So option B is the answer. Is it clear? So they will give option A and B. Always we think 1,80,000 into 10%, 18,000. It's very simple, they have given like that. But the twist they have kept here. Okay. So therefore 20,000 will be taken as the answer. Be careful with respect to these MCQs. Okay. Next. So 10,000 rupees or 10% of tax or ITC involved, whichever is higher. Then 122.2 coincides with 122.1 because this non-payment of GST is collected tax not paid within 3 months. Short payment also collected tax not paid within 3 months. And wrong availment of ITC, utilization of ITC is ITC default. And this erroneous refund is there in erroneous refund there also. So whatever offences that we have discussed in 122.2 is there in 122.1 also, which means that both the penalties are applicable. No. So there will be mutual exclusiveness. 122 subsection 1 and 122 subsection 2 are mutually exclusive. So in this regard, they have given 3 clarifications for us to understand, that is given in demand and recovery. So please look into page number 204. Page number 204. That is, there is Mr. Amar who is a supplier, and that particular person has just raised invoice to Mr. Balaji, recipient, but the supply is not made. There is no supply of goods or services. Now in this case, as there is no supply on Mr. Amar, definitely you cannot initiate 74A. even though this circular was given in the context of 73-74, but the principle in this circular is equally applicable for 74A. This is the area where I told you that it can be tested in this exam, because this circular high time they have not tested this. So therefore, they can connect the same circular with 74A. What students will think, 74A is only applicable for exam, only 74A they will read and go. But this circular they will ask, because it is there in the study material, you understood. So they will identify with the magnifying glass whichever topics the student will skip, that only they will be asking in exam, because they know the pulse of the students. So students will all depend on summary books, etc. and all. So study material they will not read. So therefore study material they will search which and all 1 line, 2 lines which students will skip, or while reading they will be sleeping. That area only they will take and they will ask. So otherwise how to curtail the pass percentage, correct or not? So therefore you be careful, you be smart, you always think the other way around, you got it? So let's hack their mind. So this circular is there in study material, but it was given in the context of 73-74, but the principle is equally applicable for 74A also. So here what has happened, Mr. Amar did not make any supply, he just raised the invoice. Is there a liability on Mr. Amar? No, there is no liability on Mr. Amar. So 74A cannot be invoked. 74A can be invoked only for recovery of tax. First of all, you don't have liability. Where from? Just because he gave an invoice, what is a taxable event? Supply is a taxable event. Invoice is not a taxable event. If supply itself is not made, where from there will be levy of GST. So therefore, there is no liability of tax on Mr. Amar. So 74A will not come, but he committed an offense. What is that offense he committed? Invoice default. So without supply he gave an invoice, for which penalty will be applicable under 122 subsection 1, that is this mutual exclusiveness. So as 73-74, now 74A cannot be initiated, so penalty will be leviable under 122 subsection 1, that is invoice default, 100% of the tax or 10,000, whichever is higher. Second chart you see. And what about Mr. Balaji? What he did? So he did not get the goods, but he got the invoice from Mr. Amar. Based on the invoice of Amar, he availed the ITC and utilized it for payment of his tax liability. Say he has a tax liability of 50,000. Using this fake invoice, he took the credit of 30,000 and he paid only 20,000. Means there is a short payment of 30,000. 50,000 is his liability. Using this fake invoice, 30,000 he utilized ITC and 20,000 only he paid. Means to the extent of 30,000 there is a short payment of tax, correct or not? So therefore will there be recovery on Mr. Balaji under 74A? Yes, because he did not pay tax. So therefore recovery will definitely be there under 74A. As 74A is applicable, even though Mr. Balaji did ITC default, 122 subsection 1 not applicable. Penalty not leviable under 122 subsection 1, because anyhow demand and recovery is initiated on him. Then third chart you see, Mr. Amar is raising invoice without supply to Mr. Balaji. Mr. Balaji availed the ITC and utilized it for a fake liability. ITC also fake, liability also fake, you understood? And thereafter Mr. Charan availed the ITC with respect to invoice of Mr. Balaji and utilized for payment of his tax liability. Now what are all the consequences? First, Amar don't have tax liability because he just raised the invoice without any supply, as supply itself is not there, so the tax liability shall not arise. So on Amar, there won't be demand and recovery, but penalty will be there on account of invoice default. Same way, Mr. Balaji, there is no tax liability, because what he did, he also did the same. He raised the invoice, but he did not make any supply, so there is no tax liability, but there will be 2 times a penalty on Mr. Balaji. What are those 2 times a penalty? One for ITC default, another for invoice default, because he gave invoice without supply. For that 1 time penalty under 122(1), and he availed the ITC without any proper receipt of goods. So ITC default, again he need to pay. So 2 times a penalty payable under 122 subsection 1. What about Mr. Charan? He availed the ITC and adjusted against his liability. So which means that there is a short payment of tax. So demand and recovery will be initiated against Mr. Charan. So therefore there won't be penalty under 122 subsection 1, even though there is a ITC default, because anyhow 74A demand and recovery will be initiated. Now that's what I have given here. Section 122 1 penalty and 122 penalty will be mutually exclusive. So whenever one is applicable, that another one will not be applicable. So basically 74A, whenever 74A is invoked, So then penalty under 122(2) only will come, 122(1) will not be applicable. Then 122 subsection 3 is on the supporting character. They are not the main party to the offence. On A1, accused number 1, it will be 122 subsection 1. On A2, A3, etc. So who are those A2, A3? Driver, accountant, chartered accountant, tax consultant, okay, your IDT faculty. So they will be coming under A2, A3 category, okay, because I will also come under abetting to commit an offence, you understood. So therefore, on us, the penalty will be only up to 25,000, up to. So if we plead our guilty, sorry sir, I don't know, then 2,000 rupees also can be levied as penalty, 0 rupees also can be levied as penalty, up to, okay, up to 25,000. That is 122 subsection 3. Offences where the person is not directly involved in any evasion, but may be a party to the evasion, or he has been asked to appear under summons. So has been given summons. Summons means he need to appear before the officer, but he did not appear before the officer. He said, if you ask, should I come or what? Like that, his ego has hurt, so he did not come. Then officer's ego will hurt and they will levy a penalty of up to 25,000 rupees. Then produce documents. So therefore, you know, they will be asking an accountant to submit the documents. That accountant will tell, no sir, my boss is not agreeing like that. So okay, fine, let your boss not agree, I will put penalty on you up to 25,000 rupees. So these penalties is on any person, not on registered person. Moreover, remember the intention of 122 subsection 3. This is not on the main culprit, it is on the supporting characters. That is 122 subsection 3 penalty. Now they will be giving a tax consultant advised a person because of which that person has evaded the tax. Now in that case, what is the penalty on the tax consultant? What is the penalty? First you need to check whether the tax consultant at his instance the offence is committed and is he the beneficiary of the offence? Yes. Then in that case 122 1A. Suppose if not at his instance or he is not the beneficiary of the offence, then 122 subsection 3, because there is already one past exam question is there related to this. Then 122 capital A. There are certain manufacturers of tobacco, pan masala, etc. They need to register their machinery which is used in manufacture. If they fail to register the machinery, then the penalty will be 1 lakh for each unregistered machine. This point also not tested in past exam, so this can be tested, okay. So up to September they have not asked this amendment. Failure to register certain machines used in manufacture of goods as per the special procedure. In this regard, one more point also is there. You write somehow there, that is, once they pass the order, they have to register the machine within 3 days. Otherwise, the machines will be seized. Okay. So, if penalty not paid, comma, machines are seized. Machines are seized. Just remember that. If penalty is not paid, the machines are seized. Then next 123 penalty. This 123 penalty will be on the person who failed to furnish an information written under 150 within 90 days from the date of notice. There is an information written under 150, so which will be given to any person to submit the taxpayer's information. For example, a bank manager will be asked to submit the bank statement of a particular taxpayer, and if the bank manager is not submitting the statement within 90 days, then the penalty will be applicable under 123 on the bank manager, which is 100 rupees per day for the failure period, subject to maximum 5,000, and this is under CGST, equal amount under SGST. What is the penalty? 100 rupees per day, subject to maximum 5,000. And next 124 penalty. This is on the same person who is required to submit the data information, but he is not submitting the information. Then 124 penalty. For example, the same bank manager is asked to submit the data of all the account holders whose gross receipts in the year exceed 40 lakhs. If he is not submitting the data under 151, so this data will be asked under 151. So what is the time limit? As specified in the notification under 151, he need to submit. Otherwise, the penalty will be, up to 10,000 rupees first time offence. If it is a subsequent offence, 100 rupees per day for the continuing period, subject to maximum 25,000. How to understand this? If it is first time offence, it will be up to 10,000. If it is a repeated offence, then it will be 10,000 rupees plus 100 rupees for every day. For example, if there is a delay of 30 days, etc., So into number of days delay, okay, number of days delay, and it is subject to maximum 25,000. So this overall is up to, for example, if there is a delay by 30 days, 30 days means 10,000 into 100 into 30. What is 100 into 30? 3,000. 3,000 pa? 3,000 only na? 30,000 ah? 3,000 only, correct. So 10,000 plus 3,000. So that will be 13,000. So maximum is 25,000. So up to 13,000, like that you need to select the option. Okay, up to 13,000. Suppose if there is a delay of 200 days, 200 days into 100 plus 10, up to 25,000, because the maximum penalty will be 25,000. This is how you need to understand. This is also not tested in exam so far, and they can ask in MCQ. Then 152, whatever information that has been obtained under 150 and 151 cannot be used without giving an opportunity of being heard to the person concerned. That is, under 150 some information is obtained by the officer, under 151 also some information is obtained by the officer. So they cannot use it just like that. They have to give an opportunity of being heard before using that information. That is 152. Then general penalty, wherever there is an offence for which no separate penalty is given, then the general penalty will be applicable, that is up to 25,000 rupees. And 3 places the penalties is up to 122 subsection 3, you check, up to 25,000, and 124 also up to 10,000, and 125 also up to 25,000. Wherever this up to is available, in that case section 126 will be applicable, which says that if there is an amount of tax or ITC involved is less than 5,000, that is called as minor offences. So what is a minor offence? Where the tax or ITC is less than 5,000, no penalty will be levied. Or if the offence is easily rectifiable and made without a fraudulent intent or gross negligence, then also this penalty can be waived off. But remember, which penalty can be waived off by the proper officer in because of these 2 reasons, that is applicable in case of section 122(3) penalty, 124 penalty and 125 penalty. Wherever the words is up to, there only the power is there for the officer to waive off. 2 cases. Number 1, maybe if this is a minor offence where the tax or ITC is less than 5,000, whether this 5,000 is total tax or CGST tax, this 5,000 is total tax, this 5,000 is total tax, both CGST and SGST together, both CGST and SGST together, total tax is less than 5,000, or total ITC, total tax or total ITC, total tax or total ITC less than 5,000, then there won't be any penalty. Or offences which is easily rectifiable and made without a fraudulent intent or gross negligence, then also they can waive off this penalty. Then 127. 127 is a notice only for levying penalty, because if there is any proceeding, already 74A1 notice is there, or under assessment there is a notice, but only 122(1) penalty if they want to levy, or 122(1A) penalty if they need to levy, there should be a notice and order, that is under 127, where proper officer is of the view that a person is liable to pay penalty and the same is not covered under any other proceeding, he may levy penalty after giving reasonable opportunity of being heard. 128 is the power to waive off the penalty with the government. The government may on the notification waive in full or part any penalty referred in 122. All subsections of 122 they can waive off. 123 also they can waive off. 125 except 124. All other penalties can be waived off, or even late fee also for delay in filing returns can be waived off by government. Then 133, officer engaged under this act. Officer engaged under this act means either the superintendent or any other officer or those who work in the GST network, etc. If they willfully discloses any information or contents of any return otherwise in execution of his duties, then there will be a penalty which is up to 25,000 or imprisonment up to 6 months or both. Okay, so this is on the officer, not on the taxpayer. This is on the officer who is in the GST department or officer who is working in GST network. On them only this penalty will be applicable, up to 25,000 or imprisonment of 6 months or both. But this is under CGST, but does not mean that, so 6 months CGST, 6 months SGST. For imprisonment and all don't count like this. Only for penalties you need to take like this. Okay, then next, look into imprisonment. So we completed 2 aspects. First one, offences that leads to search and seizure. Second one, offences that leads to penalties. Third, offences that leads to imprisonment. Remember ICE bid. What is this ICE bid? I for invoice default. So in that bio discredits TFT, we have 3 I's. invoice default, ITC default, ISD default. ISD default will definitely not be coming under imprisonment because that is not a serious offence. So invoice default, ITC default, both are given here, invoice default as well as ITC default. Then C, we have only in one place, collected tax not paid within 3 months or collected amount as tax not paid within 3 months, but which is severe offence, collected amount as tax not paid within 3 months is only severe, for that only there is imprisonment, not collected tax not paid within 3 months. Then E, only one E is there, that is erroneous refund. Then B, only one B is there, that is books of accounts default. Then D, there are two Ds, dealing in goods liable for confiscation, disposal while detention or seizure is operational. So disposal while detention is operational is not a severe offence, but dealing in goods liable for confiscation is a serious offence for which imprisonment will be applicable. So ice bid plus attempt to commit or abetting commission of ice bid, that will also lead to imprisonment. And what is this? So that is, if a person is committing the ice bid offences, on them also imprisonment. Again I told you now, accused number 2, 3 etc. they are called as attempt to commit or abetting commission of the ice bid. On them also there will be imprisonment, but the imprisonment will change. Suppose on the main person if the imprisonment is 5 years, on the next person the imprisonment may not be for 5 years, it may be 4 years or 3 years like that. So but imprisonment will be there even on those people who attempt to commit or abetting commission. Collected tax but not paid within 3 months is not an offence for imprisonment, but collected an amount as tax and not paid will be treated as offence for imprisonment. And what is the imprisonment provision? First you need to remember, for books of accounts default, the imprisonment will be always up to 6 months or fine or both for books of accounts default. For all other offences, greater than 1 crore up to 1 year, greater than 2 crores up to 3 years, greater than 5 crores up to 5 years. So 125, 135, 125, 135. First books of accounts default up to 6 months or fine or both. Then all other offences. So ice bid minus B. For all other offences, 125, 135. 125 is crores. More than 1 crore, more than 2 crores, more than 5 crores. Here up to 1 year, up to 3 years, up to 5 years. In all these cases, there is a minimum imprisonment of 6 months. In all these cases, there will be plus fine that is guaranteed. And this is for the first timers. For repeaters, it will be always up to 5 years plus fine, whatever may be the offence. So that is books of accounts default or all other offences, the subsequent imprisonment will be up to 5 years plus fine. It does not mean first time I did invoice default sir, second time I did ITC default sir, but for ITC default it is first time sir. So therefore whether it will be first time imprisonment or subsequent imprisonment only. Under this section if you are covered under any offence, second time it will be subsequent imprisonment, no second thought, it will be up to 5 years and fine and minimum 6 months will be there. And remember, this greater than 1 crore point is applicable only for one offence. This greater than 1 crore point is applicable only for one offence, that is invoice without supply, only for that offence. For example, there is supply without invoice, more than 1 crore. Will there be imprisonment? No. For all offences, there will be more than 2 crores, then only imprisonment will be applicable. This more than 1 crore point is applicable only for one offence. What is that? Invoice without supply. So therefore, for supply without invoice, supply without invoice, supply without invoice, supply without invoice, and the offence is greater than 1 crore. The offence is greater than 1 crore. Will there be imprisonment or no imprisonment? No imprisonment. There is no imprisonment in this case. And here one more point you need to keep in mind. This 1 crore, 2 crore, 5 crore, is it the total tax or CGST? Total tax. So this 1 crore, 2 crores, 5 crores, all these things will be total tax. It is not CGST, SGST like that. So it is the total tax or total ITC or total refund. Okay. So total tax or ITC or refund, total amount involved in the offence. So the tax or ITC or refund, that should be seen here. With respect to a particular demand order, whatever is the total tax plus ITC plus refund, that should be taken. And next one. So penalty under 122 subsection 1 is on taxable person, 122 1A is on any person, 122 1B is on e-commerce operator, 122 2 is on the registered person, 122 3 again on any person, 123 and 124 person who is required to file information written under 150 151, 125 is on any person. So there is one query, sir, 122 1A is applicable to Mr. Balaji along with 122 1. No, because Balaji is not the mastermind behind the offence, he is a party to the offence. So if there is a person who is not a party to the offence, means he is not involved in the offences, but at his instance only the offence has been committed, means he made the sketch, he made the plan, etc. So then only 122 1A will be applicable. So therefore in case of Mr. Balaji, he is the person who issues the invoice without supplying. So therefore 122 1 will be applicable, not 122 1A. Next one we are discussing offences that leads to arrest. What are the offences that leads to arrest? IIC. What is that IIC? Invoice default, ITC default, or collect an amount as tax not paid within 3 months, and if it exceeds 2 crores, then only arrest will be applicable. If it does not exceed 2 crores, arrest is not there. Sir, without arrest, can there be imprisonment? Yes, very much. Without arrest also imprisonment can be made. Arrest is taking a person into the custody in order to do the interrogation, whereas if he is cooperating, directly there will be case which is filed in the court, no interrogation, so he will be asked to appear before the court, and the court will pass the imprisonment order. Until that point of time, daily he will be going to the court, and whenever there is a hearing and the moment imprisonment order is passed by the court, he will tell to his family members tata bye bye and he go to the jail. Whereas in case of arrest, till the time court passes imprisonment order, he will be under the custody of the officer, that is called as arrest. So arrest and imprisonment are two separate things, don't get confused. Arrest can be there even without the imprisonment. Then so following offences where the tax involved is greater than 2 crores, arrest is applicable, that is invoice default, ITC default, collect an amount as tax not paid within 3 months. And there are certain guidelines to be followed for the purpose of arrest. Already they have asked this once as a theory question. In IBS also they can be asking this. What are the guidelines for arrest? After considering the following factors, arrest has to be exercised. There should be proper investigation of the offences, and in order to prevent the person from absconding, they can do the arrest. So first, without proper investigation of offence, arrest should not be made, and arrest is required only if the person is going to abscond. If he is going to cooperate, arrest is not required. And if there is any mens rea that is present, that is guilty mind that is present, so then they will do the arrest. And large amount of evasion should be involved. Just because it is 2 crore 1 rupee, don't arrest. Really the amount should be substantial. And possibility of tampering evidence. If he is outside, he can definitely tamper evidence, or he can influence or intimidate within. So he may kidnap the officer's daughter, and because of which he can influence. So that's the reason why he will be arrested. So either possibility of tampering material evidence, or can intimidate or influence within, or they are the mastermind or key person in the offence. If they are the backbone of that offence, they are the mastermind and they are so intelligent fellows that they can do anything with respect to that to escape. So then also they will be taken into custody. So these are the points that needs to be considered. Then what is the interconnection between imprisonment, bailability of offence and arrest provision? Here we need to understand one more point. What are cognizable offences? Again IIC, if it exceeds 5 crore is cognizable plus non-bailable. Remember, all cognizable offences are non-bailable offences, which means under the cognizable offence, if a person is arrested, arrest warrant is not required and a person can be arrested and he need to be produced before the magistrate within 24 hours, not 24 working hours, 24 hours he need to be produced before the magistrate, and the bail will not be granted to him. The bail will be granted only by the court. Magistrate will not grant. Magistrate, he need to be produced, that's it, and he will be given to the custody of the police or custody of the officer, and thereafter in the court only bail will be sanctioned. The arresting officer cannot grant the bail. Whereas other offences is there, that is non-cognizable and bailable offence. Non-cognizable means if they need to be arrested, arrest warrant is required and the arresting officer can grant the bail with respect to that offence, that is this. So total it is divided into two: cognizable plus non-bailable, non-cognizable plus bailable. What are cognizable plus non-bailable offence? Same IIC, invoice default, ITC default, or collected amount as tax not paid within 3 months. If it exceeds 5 crores, if it exceeds 2 but does not exceed 5, then it will be non-cognizable plus bailable. So that is this. So these three offences, if it exceeds 2 but does not exceed 5, it is non-cognizable plus bailable. Arrest can be made, yes, arrest can be made, and ACDC can give bail. Suppose if bail is not taken, then forwarded to the custody of the magistrate, and as it exceeds 2 crores, what is the imprisonment? Up to 3 years and fine minimum 6 months. Whereas if these three offences where the tax involved exceeds 5 crores, then in that case it will be cognizable plus non-bailable. Arrest can be made, yes, and arrest will be without warrant, and inform the ground of arrest and produce before the magistrate within 24 hours of arrest, and imprisonment up to 5 years because it exceeds 5 crores na, so imprisonment up to 5 years and fine. and minimum 6 months will be there. Apart from this, any other offences, any other offence, there might be imprisonment, but arrest is not applicable, because arrest is applicable only for these 3 offences and arrest cannot be made. When arrest cannot be made, it is not proper to call it as non-cognizable and bailable, but in study material they use the word non-cognizable and bailable. You write in exam also non-cognizable and bailable, but thereafter you write this note: when arrest cannot be made, the question of bailability shall not arise. Then next, so in case of any other offence where the tax involved is greater than 2 crore but does not exceed 5 crore, imprisonment up to 3 years, greater than 5 crore, imprisonment up to 5 years. This is the place where I told you without arrest there can be imprisonment also, that's not a problem. What are the other offences? So IIC is discussed, remaining are there na, that books of accounts default or no, this erroneous refund, etc. for that cases. And next, cognizable, non-cognizable means what we have discussed, and we have to follow the code of criminal procedure for the arrest purpose. The last area, compounding of offences. Compounding of offences, section 138. What is the meaning of compounding? Granting immunity from prosecution, that is imprisonment, is known as compounding of offences. So whenever there is imprisonment provision, the compounding of offence will come into picture. Anyhow below the table you will pay in order to escape from imprisonment, you pay it above the table right royally, so that you will be relieved from imprisonment. That is this compounding of offence. But for that, every time if you commit the offence and if you come and pay, we will not agree. So compounding is possible only in the once in the lifetime of a person. So thereafter subsequent time and all, compounding is not possible. So granting immunity from prosecution upon payment of compounding fee by the offending person, and a compounding fee will be as prescribed by the officer in the limits of 25% to 100% of the tax involved. So that is the overall limit that is given under section 138, but the actual amount is depending upon the notification in this regard. So what is the minimum compounding fee as per the act? 25%. Maximum compounding will be 100%. 100% of what? 100% of the tax involved in the offence. And again here it is the total. It is not CGST, SGST. We need to do it total. That's what I told you. Only in 3 places we need to do CGST, SGST separately. One is penalty, another is pre-deposit, third is late fee. In other places and all you need to take total. So here the 25% of total and 100% of total. But this is the overall limit, but they have given the exact limit that you can see in the next page. Offences under section 132, if it is books of accounts default or dealing in goods liable for confiscation, then in that case, or attempt to commit abetting commission of any offence, it will be 25%. Books of accounts default or dealing in goods liable for confiscation or abetting to commit an offence, it will be 25%. Or other offences. What are other offences? Invoice default, ITC default, collect an amount as tax not paid within 3 months or erroneous refund, etc. Then in that case, if the tax or ITC or refund exceeds 2 crores but does not exceed 5 crore, 40 to 60%. If it exceeds 5 crore, then 50 to 75%. This is the exact amount. Now it depends upon the question. In the question, they did not specify what is the offence. They said that it is an offence for which compounding is possible. Then what is the compounding fee you need to write? 25% minimum, 100% maximum. If they list out the offence in the question, you check which offence it is. Accordingly, you need to determine the rate. Suppose if it is B or D or attempt to commit abetting commission, this. Suppose if it is other offences, then accordingly you need to determine this. And next, sir, why invoice without supply is not given? Except invoice without supply is mentioned, because for invoice without supply, compounding is not possible. First time compounding itself is not possible, but supply without invoice possible. Yes, supply without invoice possible, but invoice without supply, it is not possible, because invoice without supply is regarded as the dangerous offence. So that's the reason why if you observe more than 1 crore itself, there is imprisonment, and even compounding also they are not giving. But supply you have made without invoice, that's okay. So for that compounding they are giving. And once a prosecution order is passed, then also compounding is not possible, because prosecution means imprisonment order is passed. Imprisonment order is passed by court, and the officer will give the compounding fee, collect the compounding fee and withdraw the case. Once the court passes the order, and if the officer says, sorry sir, I will withdraw, then the judge will say, I am a joke to you, got it? So definitely they will not agree. So that's the reason why prosecution order, once it is passed, so the compounding is not possible. And in addition to this compounding fee, such person should pay tax, interest and applicable penalty, and restriction on subsequent compounding. All offences under section 132, there is a restriction on subsequent compounding. So that's what I told you, compounding is possible only once in the lifetime of a person. and see the special points. Compounding is possible if prosecution is not initiated or during prosecution, but the prosecution order should not be passed. So during the prosecution means court case is going on, during that time also compounding is possible, but it should not be completed. After initiation of prosecution, prosecution means imprisonment proceedings in the court, and after initiation of prosecution, upon payment of compounding fee, all proceedings shall stand abated. What is the process to be followed? First, they need to make an application. So for compounding, along with the payment of tax, interest, penalty due, because already they have tested this once. In one attempt they have asked. I remember 2024, yes, November 2024 attempt they have asked the question, and thereafter May 25, September 25 they did not ask. So I am expecting a question on compounding of offence this attempt. So first we need to make an application from the applicant for compounding along with payment of tax, interest and penalty due, and commissioner will call for the records from the concerned officer, and compounding order will be passed within 90 days of the application. Keep in mind, what is the time limit within which they will pass the compounding order? 90 days. Once they pass the compounding order, within what time limit you need to pay the compounding fee? Within 30 days. Within 30 days of receipt of order, we need to pay the compounding fee. Then one more point here, suppose if there is an offence which is covered under books of accounts default, also it is other offences, then 25% is there and 40 to 60% is there, but which should be taken? Highest should be taken. However, where the offence is committed by the person falls under more than one category specified above, the compounding amount in such case shall be amount determined for the offence for which higher compounding amount has been prescribed. Then offences penalty to compounding, see this. First, if it is invoice default. Invoice default means what? Invoice without supply. Then what will be the penalty? 100% of tax or 10,000, whichever is there, because usually in exam they will be asking questions like this. So they will be giving 4 situations or 5 situations. For that situation they will ask what is the penalty, bailability, arrest, etc. We need to comment about that. So invoice without supply, penalty 100% of tax or 10,000, whichever is higher. Arrest, yes, if it exceeds 2 crore, because it will fall under IIC na, so therefore arrest will be there if it exceeds 2 crore. And imprisonment, yes, if it exceeds 1 crore itself, 1 crore itself there will be imprisonment. And will it come under cognizable plus non-bailable offence? Yes, if it exceeds 5 crore. And is there a possibility of compounding first time? No, first time compounding not possible in this case. Then invoice default, supply without invoice, penalty same as above. Arrest same, yes, if it exceeds 2 crores. Whereas imprisonment, yes, if it exceeds 2 crores, not 1 crore. 1 crore is applicable only in case of invoice without supply. And cognizable plus bailable, yes, if it exceeds 5 crore. And what is the compounding? For supply without invoice, if the amount exceeds 5 crores, then 50 to 75%. If it exceeds 2 but does not exceed 5, then it will be 40 to 60%. Then collected amount as tax and not paid within 3 months. Penalty same, imprisonment also if it exceeds 2 crore, and arrest is possible, yes, if it exceeds 2 crore, and cognizable plus non-bailable, yes, if it exceeds 5 crore, and the compounding fee will be same, and erroneous refund same as above penalty. Will there be arrest? Impossible. Arrest is only in case of IIC, not in case of erroneous refund. Arrest is not there, but imprisonment is there, yes, if the refund exceeds 2 crore. And will there be cognizable offence? No, it is never a cognizable offence because it is not in IIC. Whereas in case of compounding, what is the compounding fee? Regular, that is more than 2 crores 40 to 60%, more than 5 crores 50 to 75%. And books of accounts default, books of accounts default, penalty is there, arrest is not applicable, imprisonment is only up to 6 months or fine or both irrespective of the amount, and it will never be called as cognizable and non-bailable, and the compounding fee is just 25% only. And ITC default same as above, penalty, arrest, yes, because it is there in IIC, so if it exceeds 2 crore, and imprisonment also, yes, if it exceeds 2 crore, cognizable, yes, if it exceeds 5 crore, and compounding fee also changes, more than 2 crore 40 to 60%, and more than 5 crore 50 to 75%, okay. And dealing in goods liable for confiscation, so same as above, arrest no, and imprisonment yes, if it exceeds 2 crores there is no cognizable offence, and always the compounding fee will be 25%. Again I am repeating, this 2 crore, 1 crore, 5 crore, all these things is not for a financial year, it is based on the demand order. First they will pass a demand order, on the demand order they will file a case in the court. So for a proceeding, for a particular proceeding, whatever is the total amount, they will wait and they will accumulate and they will put everything in one single order. and that amount will be taken here. Is it clear? So please don't understand it as per invoice or per financial year. There is no concept of financial year or invoice in this case. Is that clear? Then summons is what? Asking a person to appear before the officer either to give the evidence or to produce any document or information is known as summons, and this summons will be given to the accountant, to the driver, etc., to give the evidence about the offence which is committed by that owner of the goods. And person to whom summons is issued is legally bound to appear either in person or through an authorized representative. Either that person can appear or he can make an authorized representative to appear, and these proceedings are deemed to be judicial proceedings, and if such person does not appear or does not produce documents or gives false information, that is false evidence, he can be prosecuted under IPC for contempt of court. Whatever proceedings are there, that will be applicable, plus even penalty will be applicable under 122 subsection 3. Summons are issued but he did not appear, so up to 25,000 under section 123 of CGST Act. And certain precautions to be taken. So because already they have tested this in this one past exam, in question number 6b they have tested. So write a brief note on summons and what are the precautions to be taken while issuing summons, like that. So what are the precautions while issuing summons? It can be exercised only when there is an inquiry and attendance is necessary. So only when attendance is necessary he should be asked to appear, and should not be issued repeatedly. So just because that person is looking good, you cannot ask them to come every time. So minimum number of appearances, and person should not be made to wait for longer hours unless as a matter of strategy. Like morning you will ask them to come to the office, and you are meeting them only in the evening 4 o'clock, and they will be waiting, and for that, as a matter of strategy you can do, because if you make them live without food and out of hunger, the reality will come, okay, like Big Boss. So therefore person should not be made to wait for longer hours unless as a matter of strategy, and the statement should be recorded during office hours. Come at 11 p.m. to my guest house, no, not allowed. So unless regards the facts of the case. For example, if the person is arrested under cognizable offense, he need to be produced before the magistrate within 24 hours. That's what in many movies you would have seen. Night time 11 o'clock and all, they will go to the magistrate home and they will disturb the magistrate. The magistrate also will scold them. Arey, why are you coming at 11 o'clock? So tomorrow you will go to the court, we will not be able to come, and 24 hours time will be expired. So at that time the magistrate will ask for evidence. What is the evidence? So then they can summon a person to appear before the magistrate even during the night time also, but otherwise, so statement should be recorded during the office hours unless regards the facts of the case. This is about offences, search, seizure, everything that we have completed. Okay, really hardly we took 1 hour, so we completed it. Okay, so therefore don't get confused with respect to this chapter. This much is enough. This much you need to revise and go for the exam repeatedly. On this only it is there, and you can see your solved workbook or study material related to these questions. Okay, and JAN'26 amendments, JAN'26 amendments, like that they are asking, Arey, there are no amendments for JAN'26, what should I do? I can't do anything with respect to that. I cannot create, and I am not son-in-law of Nirmala Sitharaman. Okay, I cannot create. Really it is not there, pa. Mother promise, pa, it is not there. 1 or 2 amendments, whatever is there, that I am telling. Beyond that it is not there. So even ICAI has uploaded one amendment which is copy paste of September. They are cheating you. September amendments they have copy pasted and they are putting it as JAN'26. So whatever September 25 amendments, the same are applicable for JAN'26, because actually during that time we were at war, pa. GST Council meeting did not happen. So not even one amendment came during that period. Trust me, there are no amendments for JAN'26. Okay, we'll take a break and then we will continue with the other topic, that is demand and recovery. Okay, after 10 minutes we'll continue. Okay, we'll start. There are two queries. Sir, in minor truck, mini or truck used for advertising, ITC available? Yes, ITC available. Even on EV vehicles, see, mini or truck, etc., which is used for advertising is other motor vehicles. So, ITC definitely available. What about EV vehicle? EV vehicle should be treated on par with normal motor vehicle also. Means for EV vehicle also we need to check the capacity point, etc., and all, and then ITC available. And suppose if it is a EV luggage, vehicle, definitely ITC available because it comes under other motor vehicle. What about if it is EV cars, EV bikes, etc.? That will also be treated as motor vehicle. Capacity does not exceed 13 and it will be blocked trade, ITC not available. But the capacity, that CC alone is not there for EV vehicle, okay? That 25 CC, etc., that point is not there. And next one, when transfer of ITC within registration by filing ITC 2A, is there any constitutional requirement like only companies can transfer or even proprietary concerns can transfer? The transfer of ITC is not only for companies, it is applicable to any person. Even if there is a proprietary concern, single registration to separate registrations also, ITC 2A will be applicable. And next, clarification 3, Balaji has availed and utilized the fake ITC. In that case, demand and recovery of fake ITC has to be done now. No. Because first of all, that ITC itself is fake, that is adjusted against a fake liability, means they don't have a liability at all. They don't have a liability at all. As they don't have liability at all, the question of, the reversal shall not, recovery shall not arise in this case. So then look into this demand and recovery. So those are the queries. Demand and recovery. Here, this show cause notice and demand and recovery under 73-74 is not applicable for your exam. So you don't have to bother about this discussion, that is this discussion is not applicable. So fully you can omit it completely. And 74A is only there, demand and recovery under 74A for the financial year 24-25 onwards. There is non-payment of GST, short payment of GST, wrong availment of ITC, wrong utilization of ITC or erroneous refund. And if it is on account of fraud or willful misstatement, suppression of facts in order to evade GST, the penalty will be 100% of tax or ITC or refund. The 10,000 rupees comparison is not there here. 100% of the tax or ITC or refund. Whereas it is other cases. Other cases means other than fraud. That is error. There is no intention to evade. Then the penalty will be 10,000 or 10% of the tax or ITC, whichever is higher. And there is a discount offer. What is that? Suppose if it is 10,000 or 10% of ITC, if you pay that before show cause notice, tax and interest, there is no penalty. Within 60 days, previously it was 30 days, within 60 days from show cause notice, if you pay also, there is no penalty. Otherwise, you need to pay the normal penalty that is applicable. Whereas in case of fraud cases, 100% is a penalty. If you pay it before notice, 15% will be the penalty. If you pay after notice within 60 days, then it will be 25%. Remember, before notice 15%, after notice within 60 days 25%, and within 60 days from the order it will be 50% of penalty. Otherwise, the normal penalty will be payable in this case. So there are 4 slabs. Before notice 15%, after notice within 60 days 25%, and thereafter within 60 days from the order date it will be 50%, otherwise normal penalty. Here there are only 2 slabs, that is before notice no penalty, within 60 days from notice also no penalty, thereafter you need to pay the normal penalty. But remember, this benefit of reduced penalty is not applicable in case of self-assessed tax which is not paid. So benefit of reduced penalty as above. In case of 74A is not applicable in case of self-assessed tax which is not paid within 30 days from due date. What is self-assessed tax? That tax which is reported in GSTR 1 but not paid through GSTR 3B is known as self-assessed tax. For that self-assessed tax, if it is not paid within 30 days from due date, the benefit of reduced penalty not applicable, means I need to pay the original penalty in that case. And what is the procedure for section 74A? First, we need to see the financial year 2025-26, any non-payment, short payment, wrong availment or wrong utilization. Previously, we used to determine the order due date and go backwards, but here it is not like that. First, there will be a time limit for issuance of notice, and after time limit for issuance of notice, there will be time limit for passing the order. What is the time limit for issuing notice? 42 months from the due date of filing annual return. Suppose if it is these 4 offences, you see what is the due date of annual return, that is 31st December of the succeeding financial year. From there, within 42 months, that is 3.5 years. either 42 months you remember or 3.5 years you remember. Within that time the show cause notice needs to be issued, and once the show cause notice is issued within 12 months and it can be extended for a further period of 6 months, the demand order should be passed. Okay, so keep the time limits in mind. So once the notice is issued, from there 12 months, but it can be extended for a further period of 6 months. So literally now overall period will be 5 years only, because 3.5 years plus 1.5 years, that is 5 years, and irrespective of whether it is fraud or non-fraud, there is no difference, the time limit is same. Suppose if it is erroneous refund, 42 months from the date of erroneous refund the notice to be given, and after the notice the demand order should be passed within 12 months and it can be extended for a further period of 6 months. So this 42 months show cause notice and 12 months plus 6 months is common in both the cases, but only difference is that first 4 offences it will be due date of annual return, from there we need to count, whereas in case of erroneous refund from the date of erroneous refund we need to count. Then next one what we have is 76, amount collected as tax but not paid. If any amount is collected as tax but not paid, then the recovery will be under 76. It is not first of all tax, it is amount collected as tax. It is not tax, it is amount collected as tax. Then in that case, that is representing as tax, some amount is collected. So 76 says there is no time limit for show cause notice. Even after 500, 200 years also, they can do the recovery of it. There is no time limit. They can give the show cause notice. And once they give the show cause notice, within 1 year, they need to pass the order. And the penalty will be 100% of the amount collected as tax or 10,000, whichever is higher. That point we saw now 122 subsection 1, collected amount as tax but not paid within 3 months, that penalty. But here interest is peculiar case. Usually interest will be computed from the due date till the actual date of payment, but in this case the interest will be 18% from the date of collection till the date of payment. From the date of collection till the date of payment should be taken. So for example, today that amount is collected as tax, so it should be counted from tomorrow till the date of payment of that. And always remember, in interest provisions this is common, that is from date should not be included. There are n number of Supreme Court judgments in this regard, that is given in your study material also in the chapter ethics and other provisions like that. In that clearly they have mentioned, while computing the interest, the from date should not be taken. So from the date of collection, from the due date, from the date of utilization, don't count all those from dates, but the till date, the end date should be included. Okay, so today it is collected means don't count today, you count from tomorrow till the date of payment, that is from the date of collection till the date of payment. This is amount collected as tax but not paid. And next, what is the time limit for payment of the amount? Within 3 months from the date of order, the payment should be made. Which order? That 74A order or 76 order. Once it is passed, within 3 months we need to make the payment, otherwise recovery will be initiated as per section 78. Can this order amount be paid in installments? Yes. So they have given EMI facility, maximum 24 months EMI is available, and when a person is making the payment under section 73 or 74 or 129, whatever payment he is making, he need to intimate how the payment can be made through DRC3. DRC3 is the form available to make the payment, that is before show cause notice or within 60 days from show cause notice they are making payment. So for that purpose they need to intimate in DRC3 and to the officer, and officer will issue an intimation in DRC5 concluding the proceedings. Then other provisions you see, that is section 75, general provisions relating to determination of tax. Now because of 74A, whatever is the relevant provision, that only you should know based on the 74A. First, stay granted by court or GST-80 for notice or order, such period shall be excluded from the notice or order due date. What does it mean? Say for example, for notice they have given a stay of 6 months, then instead of 42 months you count it as 48 months. So they said stay should be excluded, but you are including, while counting the deadline, the stay period should be excluded. Means during the stay period they cannot give notice, means automatically that stay period gets extended. So during that 6 months we cannot give the notice, so 42 months will be counted. Ignoring that 6 months means the overall period will become 48 months. Okay, same way, if the stay has been given for the demand order for 8 months, then this 12 months plus 6 months plus 8 months should be taken. That is common. So stay granted by court or GST-80 for notice or order, such period shall be excluded from the notice or order due date. So this point is applicable even now. Notice issued under 74 not sustainable, then convert to 73 notice, it is not applicable. Even this discussion, so this is converted to 73 notice is there now, because now there is no difference in the time limit, both will be same. At that time there was a difference in time limit, so this provision was valid. Now 74A, whether it is fraud or non-fraud, there is no difference, always the time limit will be same, so this point is not applicable. But this point will be applicable, that is whenever the notice is given under 74A and the order is also passed under 74A, we went to the appeal and there we are telling that adjudication is not done properly, that officer did not listen to us but he just passed the order. Then in the appeal case, appeal authority will not hear that case, they will send the matter back for fresh adjudication. In that case, what is the time limit within which they need to pass the order? 2 years from the date on which the matter is remanded back for fresh adjudication. Remember this 2-year time limit. This 2 year is when? From the date the matter is remanded back for adjudication. When the matter remanded back for fresh adjudication by the court or GST 80, demand order shall be passed within 2 years from the date of communication of the direction. And this chart is not applicable now. This chart is not applicable because this is related to 74 notice trimmed to 73 notice. Even this point also not applicable. In 75, this only 2 points are applicable and some more points you can see below. So this chart is not applicable, which is related to 73, 74. And looking to the next one, all these points are applicable. Proper officer shall grant adjournment for maximum 3 times. 3 adjournments can be given, and interest is payable even if not specified in the order, but penalty is payable only if specified in the order. So in the adjudication order, that is demand order under 74A or 76, only 2 places we have order. One is 74A, another is 76, yet another is 75. What is that 75 demand order? So matter remanded back for fresh adjudication. We have demand orders only in 3 places in this chapter. So what are the 3 places where we have demand orders? The demand orders is either under section 74A or under section 76 or under section 75. This 75 demand order is when the matter is sent back for fresh adjudication. On these 3 orders, if the penalty is mentioned, then only we need to pay the penalty. If just the order is passed, there is no need to pay the penalty, but interest is always payable. And also one more point you need to remember, amount in the order cannot exceed the amount in notice. If the notice is given for 5 lakhs and the order cannot be for 6 lakhs, the order can be for less than or equals to 5 lakhs. Then in case of self-assessed tax, what is self-assessed tax? Liability reported in GSTR1 and not paid in 3B. Direct recovery without an order can be initiated under 79. So without passing an order, directly they can initiate, because that is a liability which you declared in your GSTR1 for that reason. Then similar issue pending in some other proceedings in GST 80 or High Court or Supreme Court, such period shall be excluded. So the same issue in some other person's case is pending in the court. So then that particular decision, till the time they give, so here order cannot be passed in your case, that's why that period also will be excluded. So keep that in mind, stay period will be excluded, and the similar proceedings in the another High Court or Supreme Court etc., till the time they give decision, that period also will be excluded. Then section 77, tax wrongfully collected and paid. That is, you are treating intrastate supply as interstate supply or interstate as intrastate. So pay the correct tax and get the refund of wrong tax. However, if you know that before making payment of tax, using PMT9, you can shift the balances between the cash ledger. For example, you came to know that it is IGST liability, but you deposited CGST, SGST. So shift it to IGST and make the payment before filing 3B. The moment you file 3B, the shifting of balance is not possible. So the only way is to pay the correct tax and get the refund of wrong tax. But here we don't have any interest or penalty obligation because of this, because it is a revenue neutral exercise. Only thing, you did not pay the correct tax, but the tax has been paid. Then 79, recovery of tax. Recovery of tax which is self-assessed tax. Penalty for self-assessed tax not recovered through section 73, that is, so up to 25,000 rupees. So if it is 73, then the penalty will be as per 73, but now 73 is not there, so it will be 74A. 74A, that is, either direct recovery can be made under 79 or the recovery can be made under 74A. If 74A is invoked, that penalty will be applicable. If direct recovery is invoked, then what will be the penalty? They are telling the penalty will be up to 25,000. General penalty will be applicable. And what are the modes of recovery of tax? There are different modes of recovery. First, deduction from any money owed from government, and sale of goods which is under the control of the proper officer. Garnishee proceedings. Garnishee proceedings means what? Recovery from a third person, and sale of mobile or immobile property, or it will be collected as arrears of land revenue by collector, or as fine imposed by magistrate, or through surety. This is possible for a theory question. In question number 6, they can make a question related to this. These are the different modes of recovery. Then section 81, transfer of property to be void in certain cases. Whenever an amount has become due from a person, when the amount will be due from a person, the order has been passed. Once the order has been passed, before recovery, there is a time limit of 3 months to recovery. During that time, you may try to sell off your assets, but that sale will be considered invalid, that is void. So any amount has become due from a person, creates a charge, means he takes loan on that particular property, or transfers any of his property in favor of any other person with the intention of defrauding the government revenue. Such charge or transfer shall be void, provided that such charge or transfer shall not be void if it is made for adequate consideration. This sale is made for adequate consideration in order to repay the government dues. So for adequate consideration, in good faith, and without notice of pendency of such proceedings, or with the previous permission of the proper officer, then the transfer will be void. Suppose, sir, if the transfer is made before the due has been made from that person, that is before order date, after notice date, if there is any transfer that is made, then the section 81 will not be applicable. Yes, the section 81 will be applicable only if the transfer is made after the date of order. Suppose before the date of order, if the transfer is made, then for that we have another section, that is section 83, provisional attachment of revenue. The moment notice is issued by the department, this person may transfer and escape from that section 81. That's why there will be attachment of his property so that he cannot make the transfer. Provisional attachment of property including bank account after initiation of any proceedings under the assessment or inspection, search or seizure. For what period the provisional attachment will be valid? 1 year. 1 year from the date of attachment means what? If within 1 year they need to pass the order. So if they are not passing the order within 1 year, definitely this provisional attachment cease to exist and he can transfer that asset to any other person. For a period of 1 year from the date of order of the provisional attachment. And there is one point, revenue authority or transport authority or any such authority who has placed the encumbrance on the movable or immovable property. Usually whenever there is a provisional attachment, GST officer will intimate the RTO or the registrar etc. to place encumbrance on the property so that the person will not be transferring that particular property. But within 1 year from the date of such encumbrance or as per the request of the officer, whichever is earlier, that will be withdrawn. Okay. Previously for infinite period they used to place the encumbrance. So now they have made this point. Commissioner shall remove such encumbrance on the written instruction. So that is revenue authority or transport authority or any such authority who place the encumbrance on movable or immovable property on the order of commissioner shall remove such encumbrance on the written instruction from the commissioner to the effect whenever the commissioner is giving written instruction or on expiry of 1 year from the date of issuance of order, whichever is earlier. Okay. Then next we have section 82, tax to be first charged on the property, that is whenever the liquidation is happening, but this is save as otherwise provided in IBC. Any amount payable by taxable person shall be first charged on the property, means during liquidation whatever money they realize, first they need to pay the GST. But the same point we have even in income tax also, income tax to be first charged on the property like that. Then section 84, continuation and validation of certain recovery proceedings. Just keep this in mind, that is first there is a notice for 10 lakhs and the order is passed for the 10 lakhs. Against that order you went for appeal. Now the appellate authority wanted to increase it to 15 lakhs. Actually order is for 10 lakhs. You went to the appellate authority stating that this 10 lakhs itself you don't have to pay, but they increased it to 15 lakhs. Is it possible? Yes. Provided for that 5 lakhs, commissioner gives a notice. Say this. First appeal is filed against the order and appellate authority enhance the amount. This is like you are applying for re-evaluation wherein they reduced your marks. Okay. So therefore, appellate authority enhanced the amount. Commissioner shall serve notice for such excess amount. For that excess amount, the commissioner should give notice, and appeal order shall be passed on such enhanced amount without adjudication order for the enhanced amount. This can be any proceedings. It can be either appeal proceedings, or it can be even during IBC. So IBC proceedings also. And next, this circulars and all we have completed, and monetary limits for issuance of notice. So up to 10 lakhs, who will be giving notice? Superintendent. And beyond 10 lakhs and up to 1 crore, ACDC, Assistant Commissioner, Deputy Commissioner. Beyond 1 crore, Additional or Joint Commissioner. And suppose if it is IGST or CGST plus IGST, automatically it will be double. Okay. And this difference you don't have to remember, pa. This difference points you don't have to remember, because now that 73, 74 is not there. So anyhow you need to remember 74A, that you remember, that is sufficient. With this we completed demand and recovery chapter, and look into the appeals. Look into the appeals. So once the order is passed, against that order we can go for appeal. So either you can go for appeal or the department also can go for appeal. So first we need to understand who is the adjudication authority. Just now we saw that it is up to 10 lakhs, superintendent will pass the order. Beyond 10 lakhs and up to 1 crore, ACDC will pass the order. And beyond 1 crore, additional joint commissioner will pass the order. So they will be called as the adjudication authority, and they will pass either adjudication order or assessment order. And against that order, the registered person can make an appeal to commissioner appeals or additional commissioner appeals if they are aggrieved by the order. Which case it is commissioner appeals? If additional or joint commissioner passes the order, they will go to commissioner appeals. If assistant or deputy commissioner superintendent passes the order, so they will go to additional commissioner appeals. Definitely against additional commissioner joint commission order, they will not go to additional joint commission appeals, because they both are under the same hierarchy. Okay, and they will go to commissioner appeals or additional commissioner appeals. This is the first appellate authority. The second appellate authority is GSTAT, GST Appellate Tribunal, and the next appellate authority will be High Court and thereafter Supreme Court. If the issue is pertaining to place of supply or anti-profiteering, that is an amendment. If the issue is pertaining to place of supply or anti-profiteering, if the issue is pertaining to place of supply or anti-profiteering, they can skip the High Court and they can go to the Supreme Court. Okay, so that is these two cases. And there is one more authority called as revisional authority. That revisional authority, suo moto, they can take up the order for revision. Suo moto, or based on the information from commissioner, they can take up the order for revision. It is like audit of adjudication orders. One officer will pass the adjudication order and the revision authority will take up the order for revision, and they can pass a revision order. On that revision order also appeal can be filed to GSTAT, but not to the first appeal. It will be made to GSTAT. So this is the appeal process that you need to remember. And appeal to High Court or Supreme Court only if question of law is involved. If there is a question of fact, it is maximum up to GSTAT. Question of fact means, so whether the condition is satisfied or not is a question of fact. Whether the provision is applicable or not is a question of law. Whenever there is a provision which is dependent upon a condition, whether the provision is applicable or not is question of law, but the condition will be question of fact. For example, supply without consideration, whether it is supply or not, an activity without consideration, whether it is supply or not is question of law, but whether there involves a consideration or not in the given transaction is question of fact, like that. So condition, there is a provision which is dependent upon a condition, whether the condition is satisfied or not, if we need to check, that is called as question of fact, and for that maximum we can go up to GSTAT. But if you are touching High Court or Supreme Court, only if it is question of law. Even department can also prefer an appeal, and there is a pre-deposit that is required. What is this pre-deposit? Some amount we need to pay as a pre-deposit in order to show that we are interested in this case, but this pre-deposit is applicable only in case of registered person who is going for appeal, not in case of department appeal. So pre-deposit payable for filing appeal and not applicable in case of department appeal. And what will happen when we win the case? That pre-deposit will be refunded to us. If we lose the case, that pre-deposit will be adjusted towards our liability. And who can appear as authorized representative in adjudication proceedings and appeal proceedings? So before the officer, during adjudication, or in appeal, who can act as authorized representative? Either the relative of that person, or regular employee of that person, or advocate, CA, CMR, CS, or retired officer of the government, or GST practitioner. Any of this person can appear as authorized representative. Relative, regular employee, advocate, CA, CMA, CS, retired officer of government, or GST practitioner. However, a person removed from government service, not VRS, he has been removed from the government service, he cannot. And even who is convicted of an offence or found guilty of misconduct, CA, CMA, CS, who is found guilty of misconduct, professional misconduct, or adjudged as insolvent. So these people cannot act as authorized representative. Then this point also not tested in exam, they can make something related to this in MCQ. So who can act as an authorized representative? Which of the following persons can act as authorized representative? Like that they will give options and ask you to select. Then order upon which appeal can be filed. Order under section 74A, 75, 76, even 62 and 63 is assessment order, and 64 is summary assessment order. This 62, 63 and 64 is assessment order. 129 is that penalty order. On that penalty order also we can go for appeal. 130 is confiscation order. 54 is refund, and 127 is order for levying only penalty. These are the orders on which appeal can be filed before the appellate authority. And we have GST-80. GST-80 has two benches, principal bench and state bench. Principal bench will hear the issue relating to place of supply or anti-profiteering, I told you, or any other notified cases, whereas all other issues will be heard by state bench. And in the principal bench, there will be president and judicial members, and two technical members will be there. One technical member central government and one technical member state government. Whereas in case of state bench, there will be two judicial members, one technical member central government and state government, and out of these two judicial members, the senior most will become the vice president. All these are possible for MCQs because these are all some latest amendments which is not tested in exam. And suppose if the dispute is up to 50 lakhs, this is important point, please concentrate. If the dispute is up to 50 lakhs, that is less than 50 lakhs, less than, not equal to, less than 50 lakhs, not equal to 50 lakhs, less than 50 lakhs, without question of law, may be heard by a single member with the approval of president. In all other cases, there should be two members, that is a bench should be there. So like many cases you would have seen two judges will be sitting in the case. So like that, two members should be there minimum. And only in case if the dispute is less than 50 lakhs without question of law, then a single member is okay, allowed. And if the members differ in decision, suppose if there are only two members and if they are differing in decision, then what will happen? The case will be referred to another member and for majority opinion resolution, and then the majority, that is 2 out of 3. One more member will be added, 2 out of 3 will be taken as the majority and that decision will be passed. Members can be transferred between the benches by president, but technical members of a state must stay within the respective states only. And tribunal proceedings cannot be questioned. Also this point can be tested. Tribunal proceedings cannot be questioned or invalidated due to vacancies or minor defects in its constitution. That is, right now we don't have judicial members actually. Judicial members they did not select. That's the reason why even recently also lot of changes they are making to recruit CAs into the judicial member category. Okay, and but for that, so like lot of changes are required. That is, in IT also recently they have made some change that chartered accountants will be treated on par with judicial members. So therefore with 10 years experience if they have, they can be taken like that. In GST-80 also, so they are going to recruit the chartered accountants in future with more than 10 years of experience or 5 years up to them. Okay. So right now judicial members vacancies are not filled. There is only one technical member central government, one technical member state government. But these two members are sufficient to hear the case. Just because judicial member is not there, You cannot say that there is vacancy in the tribunal, which means the proceedings of the tribunal is invalid, like that you cannot question. So that is this. Tribunal proceedings cannot be questioned or invalidated due to vacancies or minor defects in their constitution. And there are few non-appealable orders. On this, appeal cannot be filed. What is that? Transfer of proceedings from one officer to another officer. So like already one officer was hearing your case and the proceedings are now transferred to another officer. You cannot say I want that officer only, like that you cannot go for appeal. Number 2, seizure. Against a seizure order, appeal cannot be filed. And imprisonment order, because imprisonment order is passed by court, on that appeal cannot be filed. And finally, order sanctioning EMIs. Suppose if you are asking 24 EMIs and they gave only 12 EMIs, you cannot go and complain, no, I want 24 EMIs, like that. These are the orders on which appeal is not possible. Then first appeal. First appeal to whom? First appeal to Commissioner Appeals or Joint Commissioner Appeals. Against whose order? So against the order of Additional or Joint Commissioner, you will go to Commissioner Appeals. Against the order of officer below the rank of Additional or Joint Commissioner, you will go to Joint Commissioner Appeals. And what is the time limit? So if the assessee is going for appeal, the time limit will be within 3 months, plus it can be extended for a further period of 1 month. If department is going for appeal, 6 months plus 1 month. Okay. Here 3 months plus 1 month, here 6 months plus 1 month. That is the difference in the time limit. And pre-deposit, but this pre-deposit is not applicable in case of department appeal. What is that pre-deposit? 100% of the admitted due, whatever they have admitted, plus 10% of the disputed tax, subject to maximum 20 crores. Previously it was 25 crores and now it is 20 crores. I think this question is already tested in the September exam. Okay. And in case of appeal against the penalty order, then the pre-deposit will be 25% of the penalty. Which penalty order? Section 129 penalty is there, na? On that penalty, 25% of the penalty will be taken as the pre-deposit. Whereas normally the pre-deposit will be 10% of the disputed tax subject to maximum 20 crores. And 100% of admitted due is not pre-deposit. That anyhow you need to pay and you are paying it because it is your admitted due. Remember, it is admitted due. Due means tax, interest, penalty, whereas 10% of the disputed tax. And is there any appeal fee for the first appeal? No, there is no appeal fee for the first appeal. And the time limit for disposal of appeal will be 1 year and it is not mandatory. Second appeal to GST 80. Against whose order? Against the order of the Commissioner Appeals or Additional Commissioner Appeals or Revisional Authority. You can go to GST 80. What is the time limit? Same 3 months, 6 months. Plus the extended time limit only it will change. Here also 3 months, 6 months, here also 3 months, 6 months, here plus 1 month, plus 1 month, here plus 3 months, plus 3 months. And what is the pre-deposit? Copy paste, no change. 100% of the admitted due plus 10% of the disputed tax subject to maximum 20 crores. And here previously it was 20, now it is only 10. Very important point. On 129 penalty, only for first appeal there is a pre-deposit. For second appeal there is no pre-deposit. Keep this in mind. This can be tested. So on the first appeal only there is pre-deposit for penalty order under 129. For second appeal there is no pre-deposit. Okay. Means you don't have to pay anything? No. Just like that you can go for appeal. And what is the appeal fee? The appeal fee in case of second appeal will be 1000 rupees for every 1 lakh or part thereof, subject to maximum 25,000, and there is a minimum fee of 5,000 rupees. For example, if the disputed tax is 14,20,000, 14,20,000 means how much will be the appeal fee? 15,000. Okay. And suppose if it is 28,60,000, then what is the appeal fee? For every 1 lakh 1,000, 1 lakh or part thereof, that is 29,000, but maximum will be only 25,000. And suppose if it is 3,40,000, what is the appeal fee? 4,000, but there is a minimum appeal fee of 5,000, so that will be taken. So see the dispute amount on what you are going for appeal, that is the dispute amount. Based on the appeal fee will be calculated. And time limit for disposal of appeal 1 year, and it is not mandatory. And there is one point, GST 80 may refuse to admit appeal if tax or ITC or penalty involved does not exceed 50,000. So it is up to their discretion. Suppose if the amount is less than or equals to 50,000, they may not admit the appeal. And as GST 80 is established recently, for adjudication order passed before 1/8, this time limit of 3 months and 6 months should not be counted from the order of the first appeal, but it should be counted 3 months or 6 months from 1/8/2018, because that is the date on which they have established GST 18. And third appeal to High Court. And when you will go to High Court against the order of GST 80, which bench? Only state bench. What is the time limit? 180 days. Plus there is unlimited continuation of delay. The pre-deposit fee etc. is not as per GST law, is as per CPC, and that is Civil Procedure Code. And fourth appeal to Supreme Court. Fourth appeal to Supreme Court against whose order? Against High Court order or GST 80 principal bench order. So Supreme Court against the order of GST 80 principal bench or against the order of High Court. But we don't have any time limit provisions, pre-deposit fee here, because that is as per CPC. And matter relating to question of law, we can go up to Supreme Court. If it is question of fact, up to GST 80. Now say this, refund on pre-deposit. So you file a case and you won the case. Now whatever pre-deposit you paid, the 10% subject to maximum 20 crores, that will be refunded to you, and this 10% is CGST. Then equal amount will be payable under SGST, because it is pre-deposit provision. And whenever they are giving refund, what is the interest rate? 9%. It's not 6%. The interest rate will be 9%. From which date to which date? From the date of deposit till the date of refund. Okay. So therefore see this. And here we don't have to file any application etc. and all. From the date of deposit till the date of refund. 9% per annum. From the date of deposit till the date of refund. Again, don't count the date of deposit, count from the next day. I told you the from date should not be taken, and no time limit prescribed for returning the pre-deposit. So they can take any time, but till that time they will be giving you the interest at 9%. And there is something called as monetary limits to department for filing appeal. So we have for GST, this is for department appeal. When department is going for appeal, so it should exceed 20 lakhs. If they want to go for appeal, the tax involved or the ITC involved in the offence should exceed 20 lakhs. And if it is High Court, it should exceed 1 crore. And to Supreme Court, it should exceed 2 crores. Then only they can go for appeal. Is it for the taxpayer to go for appeal or the department to go for appeal? The department to go for appeal. So 20 lakhs, 1 crore and 2 crores. Please keep these limits in mind. And principles to be considered while determining whether a case falls within the above monetary limit or not. Suppose if the dispute relates to tax, see the total tax. If the dispute is related to tax, see the total tax, not headwise. So CGST plus SGST plus IGST, everything together you see. And if that exceeds 20 lakhs, 1 crore or 2 crore, you can go for appeal. That is, department can go for appeal. And suppose if only interest is the dispute, then see the total interest. If only penalty is dispute, see the total penalty. If only late fee is the dispute, see the late fee. Suppose if both interest, penalty and late fee is in dispute, see everything. But when tax is in dispute, with or without interest and penalty, only see tax. Don't see the penalty. For example, tax is 18 lakhs and penalty is somewhere like 3 lakhs. 18 plus 3, 20. Okay. So more than 20. So can they go for GST 80? No. Because when there is tax and penalty, you should see only tax. You should see only tax. So this point might be tested. They will give tax 18 lakhs, penalty 3 lakhs, 18 plus 3 more than 20. But the department cannot go for appeal to GST 80, because when tax and penalty is in dispute, we need to check only tax. When only penalty is in dispute, we need to check penalty or late fee etc. And when erroneous refund is there, again total amount of refund in dispute should be taken. So while counting this limit of 20 lakhs, 1 crore and 2 crores, and monetary limit shall be applied on the disputed amount of tax, interest or penalty as the case may be, in respect of which appeal or application is contemplated. Suppose if there is a composite order, what is this composite order? Against 3 orders, they are going for appeal. So they passed 3 different orders, all 3 orders accumulated and they went for appeal. Now in this case, all 3 orders you check together. Total of these 3 orders. In a composite order which disposes more than one appeal or demand notice, the monetary limit shall be applicable on the total amount of tax, interest, penalty, late fee as the case may be, and not on the amount involved in the individual appeal or demand notice. So 3 demand notices for 3 demand orders, accumulated these 3, they went for an appeal. Now in that case, see the amount in all these 3 demand orders. If the total exceeds 20 lakhs or 1 crore etc., they can go for appeal. That is this point. Appeal should not be filed merely because the disputed tax amount involved in a case exceeds the monetary limit, and filing of appeal is to be decided on the merits of the case. suppose if the appeal is not filed in pursuance of these instructions, this is not having any precedent value. So just remember, if an officer did not go for appeal because of the monetary limit issue, it does not mean that the officer has accepted the decision, and in another case where the monetary limit issue is not there, they can definitely go for appeal, and no one can comment the officer that in the prior case he did not go for appeal means he accepted, why in this case he is going for appeal. So this precedent value is not there if they did not file an appeal because of the monetary limit issue. Actually this point is common in income tax as well as in GST. Income tax also this point is there, where appeal is not filed in pursuance of these instructions, such cases shall not have any precedent value. Non-filing of appeal based on the above monetary limit shall not preclude the tax officer from filing appeal or application in any other case involving the same or similar issue where it exceeds the monetary limit. Where appeal is not filed solely on the basis of above monetary limit, there will be no presumption that the department has acquiescent in the decision on the disputed issues. Then following cases, I don't know why first they will give monetary limit and thereafter they are giving. In these cases, irrespective of monetary limit, you can go for appeal. Okay, so see the first point, second point, third point, easily you can remember. If the act ultra vires the constitution, if the dispute is related to act ultra vires constitution, or if the dispute is related to rules ultra vires the act, or if the dispute is related to notification, circular and order ultra vires the rules or the act. Is it clear? But what is the sub judice? First constitution, next act, next rules, thereafter notifications and orders, etc. Correct? Now act ultra vires the constitution, first level. Second, rules ultra vires the act. Then third, the notifications or orders ultra vires the act or rules. If the dispute is related to that, definitely they can go for appeal. This is again common between income tax and GST. Income tax also ditto, copy paste, this is there. Okay. Then point number 4, where the matter is related to, this you need to remember, valuation, classification, refund, place of supply. Valuation, classification, refund, place of supply. Valuation, classification, refund, place of supply. Definitely they can go for appeal even without any monetary limit or any other issue which is going to have recurring implication in future. So any other issue which has recurring in nature and involves interpretation of provisions. Then point number 5, where strictures or adverse comments have been passed against the department. So against the department, strictures or adverse comments have been passed by the court. On that, if they want to go for appeal, they can go for appeal irrespective of monetary limit. These are the cases, irrespective of monetary limit, they can go for appeal. Then last, there is one authority called as revisional authority. So who is this revisional authority? Which is appointed for the purpose of revision of adjudication orders. On their own motion, voluntarily also they can take up the order for revision, or based on the complaint from the commissioner, that is information received by it, or based on the request of the commissioner, they will call for and examine all the records of the proceedings which is done by the officer. And if they come to know that the order is erroneous or illegal or improper or has not taken into certain material facts, then they will stay such order, and they can either enhance the order amount or modify the order amount or annul the order amount. Annul means cancel, either enhancing or modifying or annulling the said decision or order. Then no revision in certain cases. What are the cases revision is not possible? Number 1, if against that order we went for an appeal, they will not do the revision. But in that order, say there are 4-5 grounds on which the order has been passed, like 4-5 transactions for which the order is passed. In that, some 3 transactions we went for appeal, remaining 2 transactions we did not go for appeal. For those 2 transactions, definitely they can do the revision. Order has been subject to an appeal. However, revision authority may pass an order on any point which has not been decided or raised in an appeal, and order has already been taken up for revision. So already one officer has taken up the order for revision, then that particular order, again another officer cannot come and do the revision, and order sought to be revised is a revision order. The order has been taken up for revision by an officer and he passed a revision order. Revision of revision order is not possible. So these are the 3 cases where revision is not possible. And what is the time limit for taking up the order for revision? Suppose if appeal is filed, sir, if appeal is filed, revision should not be done now. On few grounds on which appeal is not made, on that revision can be done, and the time limit will be 1 year from the outcome of appeal or 3 years from adjudication order, whichever is later. So 1 year from the date of order in such appeal, or 3 years from the adjudication order, whichever is later. Suppose if appeal is not filed, then after 6 months from the order of adjudication and within 3 years. Why after 6 months? Because first 6 months we will not be able to, they will not be able to take up the revision order, because we can go for appeal or department can go for appeal. We can go for appeal within 3 months and department can go for appeal within 6 months. That's the reason why revision authority will interfere after 6 months from the adjudication order and within 3 years from that adjudication order. While counting this 3-year period, so 2 limits should be excluded. What are they? Stay period. Already we discussed in demand and recovery, the stay period should be excluded, and similar issue pending in any other case, that should also be excluded. So for period to be excluded in computing the limitation period of 3 years, when the issuance of revision order is stayed by the order of a court or tribunal, the period of such stay shall be excluded. Even time spent in the appeal under similar issue in tribunal to High Court or High Court to Supreme Court also should be excluded. And actually these provisions are common, equally applicable for demand order under 74A and 76, because in demand and recovery chapter also we discussed these 2 points. Then what will be considered as the date of filing the appeal? So usually the adjudication order will be uploaded in the portal. If the order is passed by the central tax officer, the order copy will be available in the portal. So the moment you file the appeal form, that date itself will be taken as the date of filing appeal. That is, order of the adjudication authority upload on the common portal. The date of provisional acknowledgement is the date. When you will get provisional acknowledgement, today you submit the form, today itself you will get the provisional acknowledgement. That will be taken as the date of filing appeal. Suppose if the order of the adjudication authority is not uploaded in the common portal, so if the state tax officer is giving the order, it will not be uploaded in the portal. So then in that case, what should be done? We need to submit the copy of the order, attested copy of the order within 7 days. So today we are filing the form, we got the provision acknowledgement within 7 days, not 7 working days. Within 7 days, we need to submit the copy, attested copy of the adjudication order. Then the date of provision acknowledgement will be taken. Within 7 days, you are not submitting the copy. The date on which you submit the copy will be taken as the date of filing appeal. This will be crucial for deciding the 3 months time limit, because the taxpayer should go for appeal within 3 months now. So that is why. So self-certified copy of the order is submitted by the appellant within 7 days from filing the appeal form. The date of provision acknowledgement is the date of filing appeal. If the self-certified copy of order not submitted within 7 days, the date of submission of copy shall be deemed to be the date of filing appeal whenever you submitted that copy after that 7 days. And this pre-deposit provision already we discussed. So both the places, that is first appeal as well as second appeal, both the cases. Now what is a pre-deposit? 10% of the disputed tax subject to maximum 20 crores, and it will be maximum 40 crores if it is IGST. CGST 20 crores, SGST 20 crores, so maximum will be 40 crores. With this we completed appeals. Now look into advanced ruling. So advanced ruling, we have a procedure for advanced ruling which I gave in page number 2 and 6. Have a look into this procedure. I think in old book it will not be there. Very old book it will not be there in the That's It book for May 25, but thereafter I have given this. Okay. So look into this procedure. First there is an applicant, and what is advanced ruling? So obtaining the ruling with respect to an activity which is undertaken or proposed to be undertaken. So some activity I am going to undertake, and I want to know whether it is a supply or not a supply, or it is available or not available, and what is the GST payable, like that. If I have any query with respect to the transaction, I can definitely go for advanced ruling. And we have two authorities for advanced ruling, AAR and AAR, authority for advanced ruling and appellate authority for advanced ruling. An applicant can make an application with the authority for advanced ruling, and they need to pay a fee. The fee will be 5,000 CGST and 5,000 SGST. And this authority for advanced ruling will send a copy of the application to jurisdictional officer, and the jurisdictional officer will give the relevant records. And after giving opportunity of being heard, and after examining the records, the authority for advanced ruling may either accept the application or reject the application. Why will they reject the application? If the proceedings are already pending before the jurisdictional officer, or if the proceedings are already decided, with respect to those proceedings, advanced ruling will not interfere. So if the question raised is already pending or decided in any proceedings, they will reject the application. Otherwise, they will accept the application. whether they are accepting or rejecting the application, that intimation will be given to both applicant as well as to the jurisdictional officer. Suppose if they accept the application, what is the time limit within which advance ruling should be passed? 90 days. This 90 days point we will come across in 3 places. Keep that in mind. First, in case of provisional assessment, the provisional assessment order, somewhere you write down, the provisional assessment order should be passed within 90 days from the date of application. PAO, provisional assessment order should be passed within 90 days from the date of application for provisional assessment. And next, compounding of offences order should be passed within 90 days from the date of application. Compounding of offences order should be passed within 90 days from the date of application. And next, advance ruling should be pronounced within 90 days from the date of application. Advance ruling should be pronounced within 90 days from the date of application. So these are the 3 places where we have 90 days point. Okay, what are the 3 places? Provisional assessment order, compounding of offences order, and advance ruling. All these 3 within 90 days from the date of application. Okay, so therefore that is common point here. Within 90 days from application, they will pass the advance ruling order, but of course opportunity of being heard will be there, and this advance ruling order will be intimated to both applicant as well as to the jurisdictional officer. And thereafter, against this advance ruling order, if the person is not satisfied, he can go for advance appellate authority for advance ruling. Okay, so appellate authority for advance ruling they can go. What is the time limit within which they need to file an appeal? 30 days, plus it can be extended for a further period of 30 days. And that authority for appellate authority for advance ruling should pronounce the ruling within same time limit, 90 days. 90 days from the date of appeal, they need to pass the advance ruling order, and that will be intimated to both. And what is the fee? So for the first authority, that is AAR, it will be 5,000 plus 5,000, and AAR extra one more A is there, na? That's why 10,000 rupees plus 10,000 rupees. It will be double. Got it? So single it will be 5,000, double it will be 10,000. Got it? Keep this in mind. This is the appeal fee, and all those points I have given again here. Please look into page 215. First authority is authority for advance ruling. Status, if there is any possibility, basically authority for advance ruling is not a single authority, there will be members. If there is any contradiction between the members, the case will be forwarded to appellate authority for advance ruling. Possibility of difference of opinion among members, in such situation application shall be referred to AAR. And geographical scope, we have only state level authority, there is no central AAR, and separate AAR will be there for each state. And one AAR given in one state will not be applicable in another state, that will be applicable only for that state. And when applicable, when application shall be made, either prior to carrying out an activity or in respect of ongoing activity. And who will be able to make the application? Either by registered person or by unregistered person. Even unregistered person also can go. And fees 5,000 CGST, 5,000 SGST. Withdrawal of application, there is no express provision related to this. And what is the time limit for pronouncing the rulings? 90 days from the date of application. What are the eligible questions? Remember your chapters. So supply chapter 2, registration chapter except place of supply. Okay, you know the index na, your syllabus index you know na. So in that syllabus, whatever you have in GST, from supply chapter to registration chapter except place of supply, that is supply, time of supply, value of supply, input tax credit, and then composition scheme and tax invoice, on all those things you can go, even registration except place of supply. So supply, classification, valuation, registration, tax liability determination, time of supply, input tax credit, and applicability of notification, that is exemptions. But some ineligible questions, place of supply, returns, payment process, penalties, etc. So you cannot go for advance ruling asking, sir, I am planning to do this offence, sir, so what will be the punishment, like that? Okay, not possible. And rejection of application, if the matter is pending in or decided by any court or tribunal, they will reject. And next authority what we have is AAR, that is appellate authority for advance ruling. If there is a difference of opinion among them, the ruling cannot be pronounced, they will drop that. Possibility of difference upon difference of opinion among members. In such situation, it shall be deemed that advance ruling is not possible on the issue. Geographical scope, we have state level authority, separate ARRR for each state like how WAR, and time limit for appeal 30 days plus it can be extended for a further period of 30 days. It got repeated. And fees will be 10,000 CGST plus 10,000 SGST. And what is the time limit for pronouncing the ruling? Same, 90 days from the date of appeal. Look into the special points. If a person is not satisfied with the ruling pronounced by ARRR, then writ petition can be filed with High Court or Supreme Court, and a regular appeal is not possible. So because first WAR, thereafter ARRR, thereafter there is no further appeal, only writ petition. And even an unregistered person can also make application for advance ruling. Even if the supply is already commenced, advance ruling is possible, and advance ruling is state wise, so there is no central. It will not be applicable in another state or to another person in the same state. For example, if I have obtained advance ruling, another person cannot use that advance ruling, or myself also I cannot use advance ruling in another state. And advance ruling is binding only on the applicant and the department, and advance ruling is valid till the time there is no change in law. If at all there is a change in law, again they need to go for fresh advance ruling. And suppose if the advance ruling or appellate authority for advance ruling is obtained by fraud or suppression of material facts or misrepresentation of facts, then that ruling will be void ab initio. So by giving wrong information, if you have obtained, so that ruling will be taken as void. Then please look into another chapter, assessment. See, all these are connected topics. Page number 182. Page number 182. Look into this various interest provisions under GST first. So first we have section 50 subsection 1, and the interest will be for delay in payment of self-assessed tax liability. And what is the rate of interest? 18% per annum, and you need to count it from the due date. Okay, that is first date after due date, means the first date should be taken, due date should not be taken, till the date of payment of GST. And in case of that, what will be considered as the date of payment of GST? The date on which you are either filing 3B or you are making the payment through DRC3, that will be taken. Section 50 subsection 3, wrong availment and utilization of ITC. Interest will be at the rate of 18% per annum, and we need to count it from the first day after the date of utilization. What will be considered as the date of utilization? Keep this in mind. The month in which the balance in ITC falls below the availed ITC, to that extent we have utilized the ITC. For example, we have availed wrongly ITC 1,50,000. Every month we are maintaining 1,50,000, 1,50,000, 1,50,000. But in any one month, if the balance goes below 1,50,000, to that extent we have utilized in that month. For that month, we need to see whenever we are filing 3B or the due date of 3B, whichever is earlier, that will be taken as the date of utilization. So from the date of utilization till the date of payment of GST. And for payment of differential amount on account of finalization of assessment. So whenever you are unable to determine the tax or unable to determine the value, you can make an application for provisional assessment. The proper officer will pass a provisional assessment order, and thereafter they will do the final assessment. So upon final assessment, when there is a difference between final assessment tax versus provisional assessment tax, that difference amount you need to pay again along with interest at the rate of 18% from the first day after due date of the month for which tax is provisionally assessed till the date of payment of GST. And section 16, yesterday we discussed, that is non-payment of consideration within 180 days from the date of invoice. So we need to pay interest at the rate of 18% from the first day after utilization of ITC till the date of addition of such ITC to liability and paid. And section 17 read with rule 42, that is final ITC, final D1 D2 is greater than the D1 D2 which is reversed from every month, that is April to March. ITC to be reversed with respect to inputs and input service exceeds. ITC reversed on the provisional basis, then 18% per annum, and the interest will count from which date? 1st April of the succeeding financial year till the date of payment of such difference. Then we have section 17 read with rule 43, that is first we need to take the ITC initially, and thereafter we need to reverse it over 60 months, and every month we need to pay interest, but that interest will be first day after availment of ITC, not utilization of ITC, availment of ITC till the date of addition of proportionate ITC to liability. Then section 56, interest on account of refund, delay in payment of refund. So whenever we are eligible for refund, so we need to make an application for refund, and within 60 days they need to grant the refund. Within 60 days from the date of application, if refund is not granted, then from 61st day interest will be payable to us at what rate? At the rate of 6% per annum till the date of refund. Suppose if the refund is arising on account of any adjudication authority or appellate authority, then the rate of interest will be 9%, but same, we need to make application and they will give refund within 60 days. Otherwise, from 61st day the interest will be computed, but in case of pre-deposit the interest will be from the date of deposit. It's not say application 60 days etc. The pre-deposit will be from the date of deposit, means from the next day you need to count. Here all these things I considered here. From means the next day only I considered. So I did not consider the from date which is given in the law. So we need to count from the next day. That's what I have given. And due date usually refers to the date of filing 3B, that is 20th of the month following every month. In the absence of information in the question, you assume that the due date of 3B will be 20th of the month following every month. And for delay in filing 3B, the interest is not computed on gross liability, interest is computed on net liability. For example, so delay in filing 3B by 10 days, gross liability 20 lakhs, ITC 18 lakhs, means the net liability is only 2 lakhs. On 2 lakhs only interest is payable. For that also now we have one relaxation. What is that? If sufficient balance you have maintained in the cash ledger as on the due date of 3B, you don't have to pay interest at all, like that one provision is there. And for delay in filing 3B, interest is payable on net liability, provided the liability is reported in 3B. Otherwise interest will be on gross liability. Now look into assessment. Assessment under GST, there are three types of assessment: self-assessment, provisional assessment and scrutiny assessment. Self-assessment under section 59. So who will be doing that self-assessment? Registered person. So they will be reporting their return, that is GSTR 3B etc. In that return they will compute how much tax they need to pay. That is called as self-assessment. So status of the person, registered person. Who will be doing the self-assessment? By registered person. Notice not applicable. Situation, every registered person has to assess the tax payable and furnish the return. And what is the time limit? By the due date of return they will be submitting the return and they will pay the tax. And officer to take prior permission, withdrawal of order, consequences, all this is not applicable. Then second assessment you see, provisional assessment, section 60, status of the person, taxable person. And who will be doing this provisional assessment? By the proper officer. Notice no question of this, because this person is only making the application for provisional assessment. Situation where the taxable person is unable to determine the value of goods or service or both, or determine the rate of tax, then they can make an application for provisional assessment. And what is the time limit within which provisional assessment order should be passed? Within 90 days from the date of receipt of such request. And after provisional assessment order, PAO, what is the time limit within which final assessment order should be passed? Within 6 months, plus it can be extended for a further period of 6 months, plus 4 years from the provisional assessment order, they need to pass the final assessment order. Officer to take permission, no. Withdrawal of order, not applicable. Consequences. So whenever final assessment order is passed, the final assessment amount may be greater than the provisional assessment amount. Then in that case, the differential amount we need to pay along with interest at the rate of 18% per annum. Calculate the difference in liability under final assessment minus liability under provisional assessment. Suppose if it is positive, means what? Final assessment is more than provisional assessment. We need to pay the difference at the rate of 18% from the first date of the due date till the date of payment. Suppose if it is negative, means what? The final assessment amount is less than the provisional assessment amount, then we need to get the refund. So you first make an application for refund. Within 60 days, if they are not giving refund, then interest will be at the rate of 6% per annum from 61st day till the date of refund. Then next, scrutiny assessment. As per section 61, first registered person will do the self-assessment and he will be filing his return. That return will be taken up for scrutiny by the department and the proper officer will scrutinize the return. And suppose if there is any discrepancy, they will be giving a notice communicating such discrepancy. So in order to verify the correctness of the return, the proper officer may examine the return and seek the explanation. So whenever they communicate the discrepancy, we need to make the payment of the discrepancy or we need to give the reply. And suppose, if you are not giving anything, if explanation is not obtained within 30 days or the extended period, or registered person failed to take corrective measures, then the proper officer may initiate audit, either department audit or special audit, or they may do recovery if they have evidence, or they will conduct the inspection to gather the evidence. That is inspection under section 67 they will be doing. That search we have seen na, that search under section 67. And time limit they have not given, but logically it should be before 74A time limit, because 74A is there na, time limit for recovery. After that the recovery cannot be made. That is, you have evaded the tax and the time limit of 5 years is over. That is 3.5 years for notice, and thereafter 1.5 year for order. The 5 year is over from the date of due date of annual return. Thereafter voluntarily if you go and tell to the officer, officer, you know that I have evaded, he can't do anything, he can't pluck anything, because time limit is over. There is a period of limitation, you understood. But don't do that in case of 76. In case of 76 there is no time limit for notice. Okay, shut everything and keep quiet. So therefore, even though the time limit is not given here, but logically that should be before the order under section 74A. Officer to take any prior permission? No. Withdrawal of order is not applicable. So what are the action that can be taken by the proper officer if positive reply is not made by the registered person, or he did not pay the tax because of the discrepancy? Any of the three things, either they can order for department audit or special audit, or they can initiate search under 67, or they can do demand and recovery under 74A. Next one, best judgment assessment. Best judgment assessment is under section 62 and 63. 62 best judgment assessment is on the registered person who is required to file returns, but returns are not filed. Where a registered person failed to furnish the returns within 15 days from GSTR 3A notice. So whenever the returns are not filed, a notice will be given in GSTR 3A. In pursuance of that notice in 3A, return should be filed within 15 days. If not filed, then they will initiate best judgment assessment under section 62. No new notice, because already notice has been given in GSTR 3A. The proper officer will do this best judgment assessment based on the information available with the officer. What is the time limit within which best judgment assessment order should be passed? It matches with 74A, that is 5 years from the due date of filing annual return. Within a period of 5 years from the date of 31st December of the financial year for furnishing the annual return to which tax paid not relates to. So simply remember, 5 years from the due date of filing annual return, they need to pass the best judgment assessment order, just like 74A time limit. And officer to take permission? No. And withdrawal of order? Yes. That is, they are doing best judgment assessment order, but we can still file the returns, because if you file the return, then the tax will be paid as per the return. So the best judgment assessment order will be withdrawn. You understood? First they gave a best judgment assessment order, but we are filing the return and we are disclosing this much tax only we need to pay. Then automatically that order will be withdrawn, but as you are filing the return, so late, you need to pay the late fee also. So where the registered person furnishes a valid return within a period of 60 days from the best judgment assessment order, the order shall be withdrawn, or it can be extended for a further period of 60 days with a late fee of 100 rupees per day. Then such order shall be deemed to have been withdrawn, however interest will be payable. Related to this late fee, they can make a question. So look into the next page related to this. Late fee for filing returns after best judgment assessment order under section 62. First, due date of GSTR 3B, and you have not filed by the due date. So if GSTR 3B not filed by the due date, so what will happen? They will pass a best judgment assessment order for non-filing of returns. And so best judgment assessment order, once it is filed, within 60 days from best judgment assessment order, you can still file the return, or you can file the return after 60 days also. Now, if you file the return after due date but before best judgment assessment order, what is the consequences? You need to pay the normal late fee. What is that normal late fee? 25 rupees per day, subject to maximum 1000 rupees or 2500 or 5000, depends. When 5000, if your aggregate turnover during the previous year exceeds 5 crores, then the maximum late fee is 5000. If your aggregate turnover during the previous year exceeds 1.5 crores but does not exceed 5 crores, then the maximum late fee is 2500. If your aggregate turnover during the previous year does not exceed 1.5 crores, then the maximum late fee will be 1000. So depending upon that, you need to pay. So normal late fee 25 rupees per day, subject to maximum under CGST, SGST. This is when if you file the 3B before best judgment assessment order. After best judgment assessment order, but within 60 days from best judgment assessment order, If you file 3B, then also the same late fee is payable. Suppose if you file 3B after 60 days from best judgment assessment order, then you need to pay normal late fee anyhow. Normal late fee anyhow you will pay, plus there is a additional late fee. What is that additional late fee? 100 rupees per day. There is no maximum. 100 rupees per day. So for the period of delay that will be payable. But don't forget, in MCQ when they give, you will do only 100 rupees per day. But don't forget, there is a normal late fee also. There is a normal late fee also. So they will give best judgment assessment order passed and the person filed the returns on 85th day from best judgment assessment order, compute the late fee payable. Immediately it will strike. 60 days no late fee. After 60 days there is late fee. So after 60 days means 85 minus 60, 25 days. So 25 days into 100, that will be, you know how much? 2500. One option will be there, 2500. Option B, 5000. Okay. Option A, 2500. Option B, 5000. Then immediately we will check. They are asking late fee, means total late fee. So 5000. Thinking that you are intelligent, you will answer. 5000 is correct. Option C and D will be there. You know what is that C and D? This 5000 whatever plus the regular late fee also would have been added. You will think, okay, by mistake they gave 5000 is only correct answer. But actually the answer is not that. So majority of the students are losing marks in MCQs because of this only. Oversight or overconfidence, or taking ICI for granted. No, sir, he is our enemy. Don't take for granted. You understood? So they will always use different weapons to attack us. You be careful. Sometimes you need to defend, sometimes you need to attack, but don't think that he is one normal watermelon star and all. Got it? So ICI is a bigger person, pa, and you are competing with them. And when you are doing that, don't take for granted. Their job is to make you fail, and your job is to crack that and clear. You understood? So therefore, MCQs, be careful, read twice or thrice and do that. Okay. But for that reason, don't waste your time. Don't waste your time, because that also they will do psychologically. You know what they will do? Options they will not give correctly. Options they will not give correctly. So no option is correct. It happened. I think May attempt. May 25 exam. Option itself is not correct. Then what they need to do, students should do. That is only the way in which mental game they will play. Okay. ICI is telling, sir, why option you did not give? No, sir, that is a strategy, sir. So that the student will wait 1.5 hours in the MCQ itself. So that next attempt, he need to give next donation for September. Okay. So for the sake of that, we will do. No, only Kumbi, Pakam, Krimi Bhojanam, etc. and all. No, normal death they will not get. Okay. So too much here. They play with the life of the student, and this particular case, be careful. Normal late fee also will come, and additional late fee will be 100 rupees per day. This is under CGST Act and SGST Act both. That is with respect to this best judgment assessment 62. Then best judgment assessment 63, status of a person, unregistered person. There is an unregistered person, but he has some liability. Why he will have liability? Maybe he crossed the turnover, but he suppressed the turnover. So where a taxable person fails to obtain registration even though liable to do so, or where registration has been cancelled under section 29, but still he has the liability to pay the tax, then in that case a best judgment assessment order will be passed under section 63 on the unregistered person, and who will assess? The proper officer will assess, and opportunity of being heard, yes, and that is notice will be given. And what is the time limit? Same time limit, 5 years from the due date of annual return. Officer to take permission, no. Withdrawal of order, no. Means either you pay as per that assessment order or go for appeal. So pay as per that assessment order or prefer appeal if not satisfied with the assessment order. Then next, summary assessment under section 64. So taxable person. Who is a taxable person? Either the person who is registered or liable to be registered. Who will assess? Proper officer. Opportunity of being heard, no. Everywhere there is opportunity of being heard. So notice will be given. But this is the place where there is no notice. Without notice itself, they will pass the summary assessment order. This is like income escaping assessment. So whenever proper officer has reason to believe that the person has evaded the tax and delay in passing the order, he may escape from payment of tax. The proper officer has evidence that the taxable person has incurred a liability, and the proper officer has sufficient ground to believe that delay in passing assessment order may adversely affect the interest of revenue. He can manipulate things. So on the spot, immediately the summary assessment order will be passed on the taxable person by the proper officer. But they need to take previous permission of additional or joint commissioner to do that, because without giving opportunity of being heard, they are taking the action. That's why. And there is no time limit in this case. Withdrawal of order, yes. When withdrawal of order, if the person says, taxable person says, sir, this stock is there, it's my mistake only, I have not accounted it, but I am ready to pay the tax as and when I am selling it, and I will account it now. So they can withdraw the summary assessment order. So the consequences, pay as per assessment order, or if order is erroneous, a proper officer may withdraw such order and follow the procedure under 74A. This is about assessment. Then look into audit. In audit, we have only two audits, departmental audit and special audit. Previously, we had statutory audit, and that stands omitted. And now GSTR 9C is a self-certified document. Who is required to file GSTR 9C? Any person, registered person whose aggregate turnover exceeds 5 crores. Exceeds 5 crores is required to file GSTR 9C. And GSTR 9, who is required to file? Person whose aggregate turnover exceeds 2 crore. Whether we should check that state turnover or aggregate turnover. Aggregate turnover. And whether they need to file separate annual return for every registration? Yes. For example, I am having registration in 4 states. While counting 2 crore and 5 crore, I need to take aggregate turnover. And once it crosses, in every registration, I need to file separate annual returns. Okay. So GSTR 9, GSTR 9C. And departmental audit is given under section 65. Who will be conducting this departmental audit? Commissioner or any officer authorized to undertake audit. When the audit is conducted at such frequency based on turnover, but that is not yet notified. And what is the time period of audit? Means audit is notified. Department audit is notified, but at what frequency is not notified. So anytime they can do the department audit, and time period to complete the audit 3 months, plus it can be extended for a further period of 6 months by commissioner. See, wherever in the book I gave plus 6 months, plus 90 days, etc. and all, don't write in answer in exam plus like that. Okay, so like that we don't have in law. You have to write 3 months, which can be extended for a further period of 6 months. Okay, this plus and all don't write part. That is a disadvantage of following summary book. This is summary book, means summary only. So you have to write it properly in exam. Otherwise, you will be losing the mark. Simple. 1 mark you lose also. 10 questions, if you lose 1 mark also, 10 marks gone. You got it? So don't think 1 mark, 2 marks only in a sir. So only a person who got 59 and sitting here will know the worth of that 1 mark. You understood? Got it? So therefore, 1 mark is important. And this plus and all don't write, which can be extended for a further period of 6 months. So total, what is the overall period? 9 months. Audit report shall be submitted to registered person and commissioner within 30 days from the conclusion of audit. Within 30 days from conclusion of audit. And who will bear the expenses? Definitely department only will bear the expenses. And what is the scope of audit? Will they check everything? Yes, they will audit everything. Audit of all books of accounts and records maintained or to be maintained during the audit period. So all financial records, etc. also they will be verifying. Notice for audit 15 working days prior to the commencement of audit. Not 15 days, 15 working days prior they will be giving a notice. And what if audit is already complete under any other law? Maybe this section also they can do the audit. For example, income tax audit over, sir. Start audit is over, sir. Okay, do GST also. No, department will come and do the audit. Then special audit under section 66. Who will be doing the special audit? CA or CMA nominated by the commissioner. Not selected by the registered person, but nominated by commissioner. When audit is conducted, if during scrutiny, inquiry or investigation, it is found that value is not correctly declared or ITC is irregularly availed, then in that case, the audit can be done, but the scope of audit is only valuation or ITC, only these two. And what is the time period for audit? 90 days, extendable for a further period of 90 days by ACDC, and audit report will not be submitted to the registered person. In case of department audit, the registered person will have the information about what happened in the audit and audit objections. But in case of special audit, the report will be directly submitted to jurisdictional ACRDC, and the expenses for audit will be borne by the department. Scope of the audit, they will do the audit of value of taxable supply or ITC availed and utilized, and notice for audit, no notice, but a direction to get audit is given. So it will be like a surprise. Directly they will come and knock our door for the purpose of audit. What if audit is already completed under any other law? Then this section may also be made applicable. So for the same year, I have seen both department audit and special audit. For the same year, same person, they have done both department audit and special audit. They can do, okay. And audit by tax authorities can be conducted for part of a year. One person started business in September. From September to March also department audit was conducted. September to March. Sir, it is not even a year. So even then audit can be conducted. The period of audit to be conducted by tax authorities is for a financial year or multiples thereof. So 3-4 years together also can they do audit? Yes. Thus the commissioner or any officer authorized by him by way of general or specific order may now undertake audit of any registered person for part of a financial year also. Then next, liability to pay in special cases. So this is a neglected area. They have not asked any question related to this. So even ICA don't know that it is there in the study material sometimes. So section 85, liability in case of transfer of business. So whenever there is a transfer of business, both transferor and transferee jointly and severally liable with respect to the dues. For example, A Limited is merged into AB Limited. Now, before the date of merger, so whatever is the liability, that not only A Limited but AB Limited both are jointly and severally liable, okay. So whenever there is takeover or merger, etc., keep this in mind. So transferor and transferee jointly and severally liable with respect to the dues. Which dues? Pre-transfer dues. Then liability of agent and principal, same way, principal and agent jointly and severally liable with respect to the supplies made by the agent. So agent is making supply, agent is having liability, not only agent, principal is also jointly severally liable. If the agent is not paying, the principal has to pay. Then liability in case of amalgamation or merger of companies. So whenever there is amalgamation or merger, that is they have passed the order of amalgamation or merger but effective from an earlier date. So first in principle they will get the shareholder approval, but the court order will be at a later point of time. Till the court order, they both are treated as two separate companies only, not the merged entities. Then liability in case of company in liquidation. When a company is liquidated, this is save as otherwise provided in IBC. So an official liquidator will be appointed. That official liquidator should intimate the commissioner his appointment within 30 days, and commissioner will notify the tax dues within next 3 months, and those tax dues should be considered by the liquidator for the purpose of making payment of GST. Suppose if it is a private company, when it is in liquidation, directors are jointly and severally liable. Directors shall remain liable jointly and severally when a private company is going for liquidation. Suppose if the private company is not in liquidation, it is continuing, but there is some dues. Even then, directors of the private limited company is jointly and severally liable. However, if a private company is converted to public limited company, then directors are not liable. That's the reason why they use SME IPO route for the purpose of enjoying that leverage. So almost every private company wanted to go for IPO and make public so that the directors can escape from the liability. However, if private company is converted into public company, then directors shall not be liable. Liability in case of partners of a firm. So partner and firm are jointly and severally liable for the dues. And retiring partner will continue to be liable till the date of his retirement, if he gives the notice of retirement within 1 month to the commissioner from the date of his retirement. For example, his date of retirement is 1st April. Within 1 month from 1st April, if he gives notice of his retirement, till 1st April only whatever liability he need to pay the dues. Suppose if he missed out giving notice of his retirement to the commissioner within 1 month, So till the date he is giving the notice of his retirement, he should continue to pay the dues even though it is after his retirement. So retiring partner will continue to be liable till the time he gives notice of his retirement to the commissioner, if notice is not issued within 1 month from the date of retirement. Then liabilities of guardians or trustees, they are jointly and severally liable. So with respect to the minor, there is a guardian, and with respect to a trust, there is a trustee. So therefore the guardians and trustees are liable to pay the dues of the minor or trust or incapacitated person. Same way, court of wards will be appointed. If there is no guardian for any person, the court will appoint one person as a guardian, that is court appointed guardian. They will be called as administrator general or official trustee or any other person. So they will be liable for dues of the minor's business. And whenever there is a death of the person, what is the liability of legal representatives? If the business is continued, then the legal representatives are liable to pay the dues indefinitely, whatever may be the amount. Whereas if the business is not continued, they are still liable to pay the GST dues to the extent of estate they have inherited, to the extent of wealth they have inherited. Legal representatives will remain liable to the extent of estate inherited. And whenever there is HUF or AOP and there is a partition of assets amongst the members, each member will be jointly and severally liable for the dues. When the partnership firm is dissolved, what about the partners? Partners will remain liable jointly, severally. And whenever there is termination of guardianship and trust, so guardian and trust will be liable jointly and severally. Then all these points also same. Partnership firm, HUF or AOP, business discontinued, then assessment can still be completed. And when there is a change in constitution, for example, admission of a new partner, whether the admission of new partner will be having liability to pay the dues before the date of his admission? Yes, before the date of his admission also. So change in constitution, partners or members will remain liable jointly or severally. And suppose if the firm is dissolved, partners or members will remain liable jointly or severally. This usually they will not ask as a 5 marks question, but somewhere in a MCQ they will connect it, or in IBS also they will be able to connect it. So that is about this assessment, audit, liability to pay tax in special cases. Now look into one chapter, payment process. Page number 144, page number 144, payment process. In this chapter there are total 4 sections. Section 49 which talks about what are the various electronic ledgers to be maintained by GST network on behalf of registered person. Section 50 which talks about interest computation, and section 51 TDS, and section 52 TCS. So in this, that interest computation, section 50 alone is very important section. So an overview of various electronic ledgers on behalf of a registered person. There will be 3 ledgers which are maintained by GST network: electronic liability ledger, electronic credit ledger, and electronic cash ledger. Electronic liability ledger will contain the details of liability of that registered person. There will be TIPFO, tax, interest, penalty, fee, and others. So these are the various dues of the registered person. And electronic credit ledger, whenever he avail the ITC. So how he will avail the ITC? ITC through GSTR 3B, or ITC 1 in case of availment of ITC on closing stock, or ITC 2 in case of transfer of business, or single registration is separated into multiple registration, or any refund that will be given into credit ledger. All this will be the inflow into the credit ledger. But remember, the balance in credit ledger can be used only for payment of tax dues. The balance in ITC cannot be used for payment of interest, penalty, fee, and others. Also, one more point to remember: whatever money that is there in credit ledger can be used only for payment of tax under FCM, not for RCM. Then electronic cash ledger. How money will come into electronic cash ledger? Whenever you make a deposit through PMT6 challan, TDS, TCS deducted by the other person. Whenever you make supply through e-commerce operator and the e-commerce operator deduct TCS, that TCS will be reflected into our electronic cash ledger. Whenever you are making supply to notified recipients, the notified recipients will deduct TDS. That TDS deducted also will be reflected into our electronic cash ledger, or any refunds. All these amounts which is there in the electronic cash ledger can be used for making payment of liability, any liability. It can be used for payment of tax dues as well as other dues. And Next, electronic liability ledger will be PMT1, credit ledger will be PMT2, cash ledger PMT5. Usually forms and all you don't have to remember for exam purpose. It will not be tested, okay, at CA final level. So just the time limits and monetary limits you need to focus, not the form numbers. Then balance in the credit ledger or cash ledger after payment of interest, penalty fee or any other amount may be refunded. There is no restriction with respect to cash ledger. For cash ledger balance, always we will get it as a refund, but the restriction is only for the credit ledger. Credit ledger balance we will be getting as refund only in two cases. One is zero rated supplies, another one will be inverted tax structure. Now look into the special points with respect to cash ledger. What are the various modes of deposit in PMT6 challan? So either through net banking or debit card, credit card, NEFT, RTGS, or over the counter cash deposit up to 10,000 rupees in a tax period. Only maximum 10,000 rupees in a tax period. UPI and IMPS. Only for this over the counter payment we have 10,000 limit, but all other cases there is no time limit. We can deposit any amount. And when the payment is debited from our bank account but not reflected in the cash ledger, we need to communicate the discrepancy through PMT7 to the payment gateway. For transfer of balances, we can transfer the balance between minor heads and major heads. What are the minor heads? TIPFO is the minor head, and CGST, SGST or UTGST, IGST and cess, we have 4 major heads and 5 minor heads. At the time of deposit itself, we need to check which place we need to deposit, and suppose if you have wrongly deposited in any particular cell, there will be a 20 cell matrix, so you can shift the balance from one cell to another cell using this form. So transfer of balances between major heads and minor heads. Balance available in the cash ledger can be transferred between distinct persons. So keep this in mind, between distinct persons we can transfer the balances between the cash ledger. So from one distinct person to another distinct person, again you will be using PMT9 for that. However, remember, transferor should have any unpaid liability in the liability ledger, then only the transfer is possible. For example, there is a registered person who is having registration in Tamil Nadu and Andhra Pradesh, and from Tamil Nadu electronic cash ledger to Andhra Pradesh electronic cash ledger they can transfer. But keep this in mind that CGST can be transferred to CGST or IGST, whereas IGST can be transferred to CGST or IGST, but SGST balance cannot be transferred. SGST balance cannot be transferred to distinct person, and CGST, IGST balance also cannot be transferred to SGST head of a distinct person. And don't use your talent and tell first I will shift from CGST to SGST and thereafter I will SGST I will shift to CGST or IGST and then I will transfer like that. Don't write. That is actually a planning which you do. That and all you should not write in exam. In exam they have already asked this question. In one RTP they have asked, I think May 24 RTP. May 24 RTP in case scenario MCQ they have asked this question. So what they have done is that they asked you and they said how much can be transferred. SGST cannot be transferred. For exam you remember that only. SGST cannot be transferred. CGST, IGST cannot be transferred to SGST head. Okay. That is these 2 points. SGST balance, of course it can be transferred. How it can be transferred you also know, I also know, but for exam you cannot write that. So SGST balance cannot be transferred to distinct person. CGST, IGST balance cannot be transferred to SGST head of a distinct person. Then next look into special points with respect to credit ledger. So whenever you have some balance in the credit ledger, you can get it as a refund only in 2 cases. One is zero rated supply. What are zero rated supply? Export of goods or services, supply of goods or services to authorized operations of SCZ. Write that. In exam, you please write that word. So SCZ like that, don't write. Authorized operations of SCZ. So what are zero rated supply? Export of goods or services, supply of goods or services for authorized operations of SCZ. That is zero rated. And next, inverted tax structure also will get refund of ITC. What is inverted tax structure? The tax rate on outward supply is less than the tax rate on inward supply. For example, I am purchasing cloth and the rate of GST on cloth is 18%, whereas I am making garments using that cloth and the rate of GST on that garment is 5%. So this is an inverted tax structure. I will be getting refund of the ITC in that case. That's the first point. Second point, refund to the original sources ledger. What is this? Sometimes by mistake we will pay the excess payment of tax. that excess payment of tax, when they sanction the refund, they will give it to the source ledger. So how you made the payment of tax? Maybe partly from credit ledger, partly from the cash ledger. So when they sanction the refund, proportionate to that we will be getting. For example, 2/3 we paid from the credit ledger, 1/3 we paid from the cash ledger. So whatever is the excess payment of tax, 2/3 will come into electronic credit ledger and 1/3 will come into the electronic cash ledger, that is into our bank account. Got it? So that is this refund to the source ledger. Where registered person has claimed refund of any amount paid as tax, wrongfully paid or paid in excess, for which debit has been made from credit ledger, then the said amount, if found admissible, proportionate amount debited from credit ledger shall be recredited to credit ledger using PMT3. Then next one you see, that is, by mistake we have claimed a refund. So for example, there is a ITC balance 2 lakhs and you claimed a refund. You claimed a refund of 50,000. So to that extent the ITC balance will come down. So whenever you claim refund of ITC, the balance in ITC will come down. So what is the balance in ITC? 2 lakhs. You claimed a refund 50,000. To that extent the balance in ITC came down. But this 50,000 is a erroneous refund. Either you paid along with interest or department has recovered from you along with interest and penalty. Now, whether the credit ledger should increase? Yes, of course, because you are paying back now. Whenever you get the refund, the credit ledger come down. Whenever you are paying back the refund, the credit ledger balance should increase. That is this PMT3A, where a registered person claims erroneous refund of ITC. Upon payment of such refund along with interest and penalty, proper officer shall pass an order in PMT3A for recredit to electronic credit ledger. And balance in credit ledger can be used for only payment of tax, but cannot be used for payment of interest, penalty, fee and others, already we know. Also, balance in credit ledger can be used only for payment of GST under FCM, but not for payment of GST under RCM. Balance available in credit ledger may be restricted for utilization by the proper officer. There are two rules where they will be restricting the balance in credit ledger, 86A and 86B. Rule 86A and B. Then balance available in credit ledger can be used for payment of tax demanded under 74A. So that is arrears of tax. Please concentrate. So somewhere in 2023 we need to pay some tax. We did not pay. In 2025 we are paying the tax. Now can we pay the tax using the credit ledger? Yes, we can pay the tax using the credit ledger, and that credit may be accumulated in the last 1 year also. It's okay. It may not be there in 2023. In 2024-25 also we would have got some credit. Using that also you can pay. There is no issue. Which means, remember, arrears of tax can be paid easily using credit ledger also. Not necessary that it has to be paid only through cash ledger. But end of the day you are going to pay anyhow interest on the gross liability. As this is arrears of tax, you will pay interest on the gross liability. So therefore you can make the payment through either credit ledger or cash ledger or both. Then this 86A and 86B is the restriction of credit available in the credit ledger. So once you have taken the credit in electronic credit ledger against all odds, so finally it came into credit ledger. After it comes into credit ledger, again the officer may suspend the credit for a period of 1 year. Again, it's not because of your mistake, your supplier's mistake. What is that? Your supplier is not in existence. Where he went, we don't know. Supplier is not in existence, or he is not doing business from the place where he has obtained the registration. Number 2, you are not in existence. You are there, but they are unable to find you. So you are not in existence, or you are not doing business from the place where you have obtained registration, or the invoice is missing, okay, or you have availed the ITC without actual receipt of goods. Without actual receipt of goods or service, you avail the ITC, okay, or your supplier has not paid the tax. In these 5 cases, so ITC availed against an invoice issued by the supplier who is not in existence or not doing business from the place where they have obtained registration. ITC availed by the recipient who is not in existence or not doing business from the place where they have obtained registration. ITC availed without receipt of goods. ITC availed against invoice for which supplier has not paid tax to government. Invoice or debit note against which ITC availed is not in existence. In all these cases, ITC is suspended for a maximum period of 1 year. And whenever the supplier rectifies, for example, your supplier has amended the registration, or you amended the registration, or you have shown the evidence that you have actually received the goods, or you have submitted the invoice, duplicate invoices, or debit note invoice, etc. you submitted, and the supplier has paid the tax. That is, whenever these mistakes are rectified, So whatever ITC that got suspended to you, you will be able to get it. What if the mistakes are not rectified? Indefinitely the ITC will be suspended. So upon expiry of 1 year from the date of restriction, the registered person shall be able to debit the input tax so disallowed, subject to any other action that may be taken against such person. Then we have Rule 86B. What is this Rule 86B? Rule 86B talks about payment of 1% of your liability through electronic cash ledger, even though you have sufficient balance in the electronic credit ledger. So whenever you are doing this question number 1, 14 marks question, be careful, because Rule 86B implication will definitely be there. So what will happen is that, so there will be liability. So liability and ITC, for example, liability is 9 lakhs and ITC is 9,50,000, means you have more ITC than your liability, but you cannot adjust fully. You have to pay 1% of the liability through cash ledger, which means 99% of the liability you can set off from the ITC. But for that, what is the condition you need to check? See the taxable turnover in that month. Whether the taxable turnover in that month exceed 50 lakhs or not, you need to check. And 50 lakhs is taxable turnover excluding zero rated turnover. So don't count. We have total 4 supplies: taxable supplies, exempted supplies, non-taxable supplies, zero rated supplies. Don't take zero rated, don't take non-taxable, don't take exempted. Just see the taxable. If it exceeds 50 lakhs, then Rule 86B will be applicable. Turnover in a month exceed 50 lakhs, and that turnover will be aggregate turnover or state-wise turnover. State-wise, that particular state-wise, they did not use the word aggregate turnover, they use the word turnover. Okay, turnover in a month exceed 50 lakhs, and the turnover will be total supplies minus exempted minus zero rated, and exempted includes non-taxable. So directly they could have given taxable turnover, but they are telling this and they are telling all others will not be included. They have to pay 1% of gross liability through cash ledger, even if there is balance in credit ledger to pay, but you have to pay that 1%. And to whom it is not applicable? To their family members. Government department, PSU, local authority, statutory body. I myself beggar, I am asking you 1 rupee, then what is the point in asking my family member? He is also beggar only, na? So therefore government department, PSU, local authority or statutory body is not required to pay this 1%. So others. And also some more relaxation is there. The above rule is not applicable also in the following cases. What is that? Already they are paying more amount. So mainly this rule is brought in order to create a cash inflow to the government, and already they have created a cash inflow in the form of income tax. That is either the person or the karta or the managing director or any 2 partners paid income tax more than 1 lakh in the last 2 assessment years. Such person or proprietor or karta or MD or any of its 2 partners deposited income tax. This income tax will be which income tax? Tax on total liability or tax on total liability minus advance tax TDS TCS, which should be taken before deducting advance tax TDS TCS. The tax on total liability including surcharge and health and education cess is there, na? That should be taken. So that before deducting advance tax TDS TCS, you see how much amount it is, and if that amount exceeds 1 lakh in each of the last 2 years, then 86B is not applicable. And they received a refund of ITC greater than 1 lakh in the preceding year. Already they have lot of excess ITC and they are receiving the refund. Again on the ITC restriction, if they put, that is not valid. So that's the reason for them ITC like 1% not applicable. And they say this: paid greater than 1% of the total output tax liability cumulatively up to the month in the current financial year. Say for example, from April to September, already they have paid 2 lakhs from the electronic cash ledger, divided by up to September, you see how much is the liability. So up to say August, already they paid 2 lakhs per, now we are in September. Say up to August, already they have paid 2 lakhs. So take 2 lakhs in the numerator, divided by, in the denominator you see what is your gross liability. Say the gross liability is 190 lakhs. So 2 lakhs divided by 190 lakhs is how much? 2 lakhs divided by 190 lakhs into 100. So what is that? More than 1%? Correct or not? So for September month, we don't have to comply with Rule 86B because already we paid more than 1%. So how to calculate that more than 1%? See the total amount paid through cash ledger but don't take RCM liability, because RCM liability anyhow you pay through the cash ledger. Don't take that. So payment through electronic cash ledger up to previous month in the financial year divided by total gross liability, only FCM liability up to the current month in the financial year. That's what I told you. From April to August, right now you are in September month. From April to August, you see how much you already paid through cash ledger, 2 lakhs excluding RCM, divided by total liability is somewhere like 190 lakhs. So 2 lakhs divided by 190 lakhs into 100, that is including September month, you take into 100 greater than 1%, means for September month rule 86B is not applicable. Suppose if it is less than or equals to 1%, what if your gross liability is somewhere like 250 lakhs, 250 lakhs. So numerator 2 lakhs divided by 250 lakhs into 100 less than or equals to 1%, then for September month you have to pay whatever liability into 1% through cash ledger. So less than or equals to 1%, pay 1% of liability through cash ledger in the current month. So this they can make as a MCQ. This they can make as MCQ, or in the first question, 14 marks question, they can connect this point. Okay. Next, look into this section 50. Section 50 talks about interest on delayed payment of tax. There are 3 situations where there will be interest under section 50. Situation 1, there is delay in filing GSTR 3B and interest will be at the rate of 18% from the first date after due date till the date of payment. And remember, whenever there is a delay in filing 3B, interest is always computed on net liability. What is net liability? FCM liability minus ITC plus RCM liability. So that is the amount on which GST like interest will be computed. And what will be considered as the date of payment here? The date of payment is the actual date of filing GSTR 3B. And in this regard, there is one amendment. If sufficient balance is maintained in the electronic cash ledger as on the due date of GSTR 3B, even though you filed a 3B late, but there is balance in the cash ledger under any head, not specific head. For example, you have to pay CGST 40,000, SGST 40,000, but IGST head 80,000 is there in the cash ledger. It's okay. Under any head in the cash ledger, under any major head or minor head, the total ledger balance you see, if the total ledger balance of the cash ledger, if you have sufficient balance, then you don't have to pay interest. Initially, CA Institute gave only that head balance. Thereafter, they gave a correndum, and based on that, they gave the total ledger balance. Got it? So you have to see. So in our solved workbook also, in payment process, Miss Nitya, like that one question is there. In that question, I made a mistake based on ICA's mistake, and thereafter they have given the correndum. That's why I'm telling you. So just check the total ledger balance. Total ledger balance, you see, if the total ledger balance there is sufficient, that is enough. You don't have to check that head alone. You can see the total. If sufficient balance is maintained in the cash ledger by the due date of 3B, interest is not payable on account of delay in filing 3B, check the total ledger balance. Check total ledger balance. Total ledger balance under all heads. Under all heads. Check total ledger balance under all the heads. Then look into second one. Situation 2. Invoice not reported in GSTR 1 and 3B of a month but paid in the another month. So this is arrears of tax. You have not reported, but you are paying it later, arrears of tax. Then interest will be at the rate of 18% from the first date after due date till the actual date of payment. And whether we need to compute it on gross liability or net liability, definitely it will be on gross liability, not on net liability. That's what I told you. 2022 liability you are paying in 2025. It may be paid using credit ledger or cash ledger, but we need to compute interest on the gross liability. And what will be considered as the date of payment? Date of payment will be actual date of 3B. And suppose if you are not making the payment through 3B, you are making payment through DRC3, that will be taken. If payment through DRC3, then date of filing such form will be taken. Then next, situation 3. ITC wrongly availed and wrongly utilized. So then interest will be at the rate of 18% from the first date after utilization till the date of reversal or payment, and it will be computed on what? Computed on the ITC utilized. What is the meaning of ITC utilized? The balance, the extent to which the balance in ITC falls below availed ITC, and what will be taken as the date of utilization. First, you need to see the month in which the balance in ITC falls below the wrongly availed ITC. For that month, whatever is the actual date of 3B or due date of 3B, whichever is earlier, that will be taken as the date of utilization. So date of utilization is actual date of 3B or due date of 3B, whichever is earlier, with respect to the month in which balance in ITC falls below wrongly availed ITC. Then what is the date of reversal? Either 3B date or DRC3. And first you need to see, they will be giving the information. They will give opening balance, ITC availed, ITC utilized, closing balance, like that. See, whichever month the balance in ITC falls below. Sir, if the balance increases, does it mean we reverse the ITC? No. If the balance decreases, we have utilized the ITC. Balance increases does not mean we reverse the ITC till the time we do actual reversal. So it is not considered as ITC reversed. Okay. So just see the balance in which the month in which the balance in ITC falls below. That month, to that extent, the ITC is utilized. See the next month actual date of 3B or due date of 3B, whichever is earlier, and till the date of reversal will be actual date of 3B or DRC3. How to check the balance in ITC while computing interest for wrong availment and utilization of ITC? How to check this? Suppose if IGST credit is wrongly availed, check the balance in all the heads. CGST, ITC balance in all the heads. CGST, SGST, IGST. Suppose if CGST credit is wrongly availed, just check the balance in CGST and IGST. What if SGST credit is wrongly availed? SGST and IGST. What if compensation cess credit is wrongly availed? Only compensation cess. What if CGST, SGST wrongly availed? Both. Then check all the three. Okay. See, if only CGST is wrongly availed, we are checking CGST and IGST. What if CGST and SGST credit wrongly availed? Both. Credit wrongly availed. Then what we need to do in that case? Check balance of what? Check balance of ITC in all three heads. All three heads. What is that? That is CGST plus SGST plus IGST. Understood? So this point may be tested, because already they asked the question on ITC wrongly availed and utilized. One interest computation they tested, but this they have not tested. Giving multiple balances and asking you to compute the interest, they have not tested. So this point may be possible. So that is about these two sections, 49 and 50. And we are left with 51 and 52. From that we will see in our next class. So today a major chunk we completed actually. Input tax credit we have seen, search, seizure, offence and penalties, demand and recovery, and appeals, advance ruling, assessment, and in payment process few portion. All these are the theoretical topics, but definitely you will get the application based questions. So tomorrow task, you understood what you need to do. What you need to do? See the questions on this. Okay. So you have to see, because there is no practical questions in this. All are situation based questions, application based questions. So what you need to do? Either you take solved workbook if you have. If you don't have, you will have some compiler book na. In that you start solving it. Okay. Are study material questions, but study material we don't have that many questions. Study material we don't have that many questions, so therefore you start solving those questions, and if you have any doubts, so please ask me tomorrow, so I will be able to respond to that. Okay. And tomorrow agenda is that we are going to cover in tomorrow's class. This TDS TCS is left. Exemptions, RCM, e-commerce operator, and that supply, those areas we will be seeing. Okay. So that overall coverage will be there, and day after tomorrow we will complete the GST. That whatever portion, remaining portion, whatever is left, we have small topics only left like refund, etc., that we will be completing. Got it? So, but you need to prepare in the same pace. Okay. So, morning you are doing that, today you did not do, still articleship? No. Okay. So, quit, quit. So, for whose benefit you are doing articleship, no one is getting benefited, you are also not getting benefited, no, they are also not getting benefited, just waste of time. Okay. So, quit, okay, quit or do something, tell grandmother died, grandfather died, or some reason you tell, okay, quit that first, sit and prepare. Okay. Hope you are preparing. Yes. So, see, dedicate these 6 days for indirect tax so that we will complete it. So, other subjects you can focus upon. Okay. Thank you. We'll meet tomorrow.